This is Sherry. I'm your host for today's Traders Exclusive webinar. Our title is, we're calling it the Traders Exclusive Strategy Series, and our experts today are going to show you how to spot and bank wins by identifying major market moves, a goal process to double your account, how you can help protect your retirement accounts from a crash, and how you can turn a morning or two each week into the best quote-unquote part-time job you've ever had. Now, please check out our website, tradersexclusive.com, and that's where you'll find regularly posted articles and video clips with valuable trading tips and techniques. This is also where you're going to find a recording of today's webinar. Plus, we'll be sending the link out by email to everyone who registered. Yes, Greg, they are going to be recorded. So before we get started, I've got to share with you a quick disclaimer, and you're going to want to carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time, and past performance is not necessarily indicative of future results. I'd really like for you to take notes, and if you have questions, and I hope you do, please write them down with some context, but hold them until the last 5 minutes of each presenter. So every presenter is going to go for 45 minutes. They'll train you and teach you strategies for 40 minutes approximately, and then we'll have time for questions and answers at the end. So instead of us interrupting them during the presentation, I'd like to give all their questions at the end. So I would like to introduce Silas Peters to you. He is with Seasonal Swing Trader, and he's going to talk to us about top tools for catching corrections. Hold on a second, I went the wrong way. So we're going to do top tools for catching corrections and major market reversals. Now, Silas has been an active trader for over 12 years, focusing on equities, commodity futures, currencies, and options. And he began working on a global trading desk at the Chicago Board of Trade right out of college, executing trades for hedge funds, banks, institutional investors, and high net worth individuals. And in addition to working on various trade desks, managing and executing trades in the US, European, and Asian markets, he's helped build and manage several futures and equity brokerage firms, handling day-to-day operations, trading, risk, and support. He's also worked as a private family office investment consultant and managed fixed income and equity portfolios within trust and asset management banking units. He currently holds or has held Series 3, 7, 30, 34, 65, and 66 securities and futures licenses. Wow, I'm out of breath. Seasonal Swing Trader identifies historical seasonal trends and market cycles on up to 40 plus years of historical market data and delivers quality, actionable trade ideas that put probability in your favor. Wow, you guys are going to want to take note. Now, Silas, I'm going to make you the panelist. You are muted yourself. Are you with us? You got to unmute yourself. I see your screen. I saw your screen.
Hey there, Sherry. Can you hear me?
I can hear you. Welcome. Thank you for joining us. This is going to be cool.
Yeah, I very much appreciate the invite. Glad to be here. Glad to be in front of your folks, and excited to share some trading wisdom with your folks. And can you see my screen now?
Yes, I can. And just let me know when you want me to drop a link in the chat so everybody can get a hold of you later.
Okay. And I don't see the questions, I don't think.
No, I'll assign them to you because you're a panelist, not an organizer.
Gotcha. Okay. All right. Are we ready to go?
Ready. I'll mute myself and you take it away.
All right. Well, thanks a lot, Sherry, and to the Traders Exclusive team. Appreciate you having me on. I know that I only have about 45 minutes or so. This presentation typically lasts an hour. So I'm going to try to really get to the meat of the presentation, teach you the setup, the strategy. It is 100% actionable. In fact, you can start using it today, and it is one of my bread and butter setups. And most importantly, it works. So otherwise, I wouldn't be here wasting your time nor my time. Very, very pleased with it. So let's go ahead and get started. You are here to see top tools for catching corrections and major moves. My name is Silas Peters of Seasonal Swing Trader. I think Sherry gave you a nice introduction there of me, so I appreciate that very much. I want to say welcome. Thank you for your time, for being here, tuning in. I realize everybody has commitment, so it does mean a lot that you are turning in. Shows that you are serious and committed about learning a real trading strategy that can produce real results. But before we begin, we must start with this risk disclaimer as required by the regulatory governing bodies and our attorneys. Past performance is not necessarily indicative of future results or substantial risk of loss associated with trading. Only risk capital should be used. The Cliff Notes version of this means don't trade with your rent money, your mortgage money, your child's educational funds, milk money, ice cream money, and so forth. Trading is risky. You can lose more money than you put into your trading account. So now's the time you want to shut everything down, remove all your distractions. That means closing browser tabs, logging out of Facebook, put your phone on mute. Hush the crying baby. We're going to be together here for about 45 minutes or so. Make sure you listen closely and take good notes. I'll address everybody's questions at the end if there is time. Before we begin, let me formally introduce myself again. My name is Silas Peters. Simply put, I'm a husband, father, son. I love hanging out with the fam, whether it's at the beach, on a boat, hiking, or on the golf course. Here's some pictures of me showing you that I am a real person. I'm not a robot. My wife, 2 kids, and my dog there photobombing as well. I spent a lot of time working, a lot of time in front of the screen. So when every chance I have to get outside and enjoy the great outdoors, that's what I intend to do. But how did I get here, get to where I have the privilege of speaking to you today? Well, in college, I majored in investment finance and economics. That's good and great, but I had no idea where that was going to send or land me. Fortunately, one of my dad's golfing buddies used to be an ex-wheat trader in the grain pits of Chicago. And we were playing one day. He's asked me what I was going to do. Had no idea. We started talking. One thing led to another. I went back. I started doing some research on Chicago, the trading floors, trading commodities in general. I was immediately intrigued. I was enamored by everything trading and even Chicago. What did I do next? Needless to say, I was a bit green on the sleeve. When I sold my car 3 days after I graduated, rented a U-Haul, and I drove to my new digs in downtown Chicago, signing a lease here on the 23rd floor of the Marina City, or the 2 honeycomb towers overlooking the beautiful Chicago River. Actually, that same day I moved in, I took the U-Haul truck back to this depot, hopped on an Amtrak, and I scalped a couple tickets to the U.S. Open at Olympia Fields to chase Tiger and Phil around. So I call that my first trade of Chicago. But back to my journey, or my career path, if you will. My first career entailed this. I want you to picture this. I was working the Asian, European, and early New York session trade desk. And if you remember me telling you I sold my car, well, this picture here could literally be me walking to work at some time around 6 p.m., 2 a.m., or if I got off early, maybe 6 a.m. And I remember on numerous occasions, me walking down the middle of LaSalle Street, staring up at the great Chicago Board of Trade with the God of Grains or Siri staring down upon me. Nobody but me and a snowblower in the entire city of Chicago, and then getting into the Board of Trade with a temperature reading a solid negative something degrees. Now, I'm from deep South Alabama on the Gulf Coast, Gulf of Mexico. I know nothing but heat and humidity, so that was certainly a wake-up call. I did this for a few years, working at the Board of Trade, handling some serious trade size across the Chicago Board of Trade, the MERC, NIBOT, NYMEX, various London and Asian exchanges for our hedge fund banks, CTAs, trading everything from corn to copper to hogs, Eurodollars, Japanese government bonds. Incredible learning experience, both with markets and in trading, as well as the Chicago big city life. But I decided to head back south when some other opportunities opened up. And that's when I went truly corporate. I went from a fast-paced and somewhat stressful hedge fund trade desk to a more slower-paced life, managing equity and fixed income portfolios and other investment management roles in this glass building. I was then led to a day trading firm where I helped run operations, to then running a couple of brokerage firms, and then ultimately working in a private family office serving ultra high net worth individuals. So it's safe to say I've seen a lot of the spectrum in the finance world, but honestly, I was just not that happy. I wanted to get back to the markets, to the charts, to the trading. And while I was still trading during this time, I missed being in the weeds of the market, following the charts, doing the analysis, and so on. So I left the corporate world. I started Seasonal Swing Trader, where it's here where I publish research, ideas, and analysis to my followers, and it holds myself and our community accountable each and every day. But during my journey, there were certainly some painful lessons to be learned. I grew accounts, blew accounts, grew accounts, blew accounts. I learned I wasn't a trading god. I wasn't above the market. The market didn't care about my opinion or what I think it should do. So what does that mean? It meant blown accounts, emotional trading, acting like a gunslinger, poor risk management. But these are all battle scars. And in this workshop, I'm going to attempt to help you think smart, think logical with a proven price action strategy and plan, so you can avoid the many mistakes that I'm sure several of you have made or are making at this moment. Let's talk about you. Why are you here? You are here to have a reliable pattern for all market conditions, to have a strategy for all asset classes, and to be agnostic of market bias. Because in today's markets, it's imperative to make certain we have a strategy that can trade both ways. Let me let you in on a little secret. The market is not going to continue to go higher. We need to employ strategies that can profit during up markets, down markets, and sideways markets, and do also without guessing. So today, I'm going to show you a pattern that results in trend reversals, the point where a trend is likely to reverse, and a pattern with the least risk and highest reward. So if that sounds good to everybody, let's get right to it. And you're not only going to learn a strategy that is extremely low risk, high reward, but also works in all markets, timeframes, asset classes, and conditions. So I'm going to show you a simple and straightforward strategy that works in any of these conditions: ranging, consolidation, contraction, expansion, low vol, high vol. Doesn't matter if you're a tick trader, day trader, swing trader, position trader, you trade options or the underlying. What I'm going to show you is powerful, and I'm actually going to prove it to you. Before we continue though, it's important that we cover the process. Has anybody here heard of Jesse Livermore? I encourage you to read Reminiscences of a Stock Operator if you ever get the chance to do so. A question I often receive is, Silas, what do you think about the markets here? What do you think, where are we going? My typical response is, I don't know and I don't care. And I know that may sound a bit harsh, maybe it sounds ill-informed, especially when you're asked by friends or family members, but it's true. For the most part, I really don't care about the daily news that flow in and out of the market, because I'm a trader that trades strategies based off probabilities. So we want to forget about market assumptions and only focus and trade with high probability strategies and what is actually in front of us. And that means no more predicting. Successful traders know that what is going on in the news and knowing how to make money consistently are two separate things. And we know that it's about your strategy, your logic, and your process. It doesn't matter what we think the market is going to do tomorrow. And I realize it's a difficult concept for maybe new traders to understand, and even seasoned traders. I certainly want to form my own opinion. It's just human nature. And it took me years to figure this out. It doesn't pay for us to try to absorb every financial story or slap every indicator on a chart. All I care about is when the markets I'm following reach key criteria, but there is one more trait. Because if we allow probabilities and not talking heads to find our next move, we need to really possess and control one more trait, and that is patience. Because we as smart traders know that trades should never be forced, because a forced trade is not a statistically sound trade. Again, we are in this for the long game, and patience is expected. Boring, I know that may sound boring to the aggressive crowd out there, but I'm more interested in the profitable trades, not trying to be a short-term hero who tries to trade every scenario out there. Patience is the key ingredient to success of this strategy and really all strategies that you may wish to employ. So what is a high probability strategy? It's one that requires patience coupled with a disciplined approach. It also recognizes that opportunities are made up easier than losses. And then lastly, I realize that the less I trade, the better my strategy will likely perform over the long term. And the long term is what matters. And this likelihood is what makes my high probability strategy unique and successful. But the grand takeaway overall is patience pays in the trading game. So, Silas, what indicators do you use? What's the secret sauce? What are the ingredients? Well, we talked about the ingredients being, key ingredient being patience. I learned early on to keep it simple. Pick a few indicators, try to follow them forever. I can't tell you how many traders I know want to come to me with Donchian channels, market profile, GAN, Bollinger Bands, Fib retracement. The list goes on, and there's nothing wrong with that. But this high probability strategy uses price action alone plus one very common and free indicator, along with a couple of pro tips to take advantage of sentiment and technical extremes. So I'm sure everybody's seen Jerry Maguire, love it or hate it. This is a famous line. I'm not going to jump up and down on my desk and scream this like he does. And I can't show you the money because I don't know how you personally trade, but I will show you the opportunity. So let's get right to it. It is divergence. Wow, what a brand new concept, right? No, of course not. Everybody knows what divergence is. And if you don't, that's fine too. I'm going to show you. But before you leave because you think you know what divergence is or you think it's subjective, I encourage you to stick around to show you how we use it with our little special sauce. So let's quickly cover it. Divergence is when the price of an asset is moving in the opposite direction of a technical indicator, such as an oscillator, or moving contrary to other data. Divergence warns us that the current price trend may be weakening and in some cases leads to the price changing direction. So basically it's an indicator and price being in disagreement using any relevant indicator such as MACD, RSI, stochastics, and so on. It's an indication of a reversal or a continuation, but more often a reversal. So what is it? It can occur between the price of an asset and almost any technical or fundamental indicator or data. It's typically used by technical traders when the price is moving in the opposite direction of that technical indicator. Positive divergence occurs when the price is moving lower, but a technical indicator is moving higher or showing bullish signals. Negative divergence is just the opposite. It occurs when the price is moving higher, but a technical indicator is moving lower or showing bearish signals. It is the earliest indication of a reversal, a good sign to exit, a good sign to scale, and it means that we're usually buying near the bottom or selling near the top. Hint, hint, that means that the risk on your trades are very small relative to your potential reward. So let's talk about types. We have bullish and bearish classic divergences, or sometimes called regular. We also have hidden divergences, but we're going to talk about classic today. Bullish divergence is when price action makes a flat bottom or lower low and higher low in the oscillator. Bearish divergence is when price action makes a flat top or higher high and a lower high on the oscillator. Traders use divergence to assess the underlying momentum on the price of an asset and for assessing the likelihood of a price reversal. So if the market's making new highs, but the RSI starts making lower highs, this is warning us that the price of the uptrend may be weakening. That's when we have negative divergence. Positive divergence is the opposite situation. Imagine the price of your stock making new lows while the RSI makes higher lows with each swing. Traders would then conclude that the lower lows in the price are losing its downward momentum and a trend reversal may soon follow. So let's take a look at some charts here. Let's talk about regular divergence. This is an example of regular bullish divergence. It's the most frequent and usually considered a sign of a reversal. Price is making lower lows, lower lows, but the oscillator is making higher lows, higher lows. We have bullish divergence. We don't need a series of lower lows. We only need one low to be lower than the previous low. And this can usually be found near bottoms. Let's talk about regular bearish, also the most frequent. It's considered a sign of a trend reversal when the price is making higher highs, higher high, but the oscillator is making lower highs, high, lower high. This can typically be found near tops. Let's talk about identifying trend strength, and let's consider the following scheme. At point one here, we have buyers that believe a trend has begun and they want to step in and make money. So what do? They start buying the market, they're opening long positions and driving the price higher. The trend accelerates as more and more buyers are jumping into the market. At point two here, buyers are starting to take profits, the trend starts to weaken, buyers still dominate, but they calm down a bit because they're afraid that the trend is coming to an end. Then we get to point three, no more buyers to the market, the trend's likely to reverse, sellers step in, and they begin to dominate the buyers, and the trend actually reverses. Now, we can use tools to help recognize trend and trend strength, and one of those can be found with the popular RSI indicator. I think the standard rule of thumb, if you will, is when the RSI rises above 70, the market's considered to be overbought. When the RSI falls below 30, the market's considered to be oversold. And that's a great concept, but we want to use the RSI in a slightly different way. Let's look at the same chart again. Two significant highs here labeled A and B on the price chart, as well as in the corresponding window pane below, A and B. In the price chart, we see that B is higher than A. That means the price is still going higher. In the RSI pane below, it's just the opposite. B is lower than A. It means that the trend is weakened and is likely going to reverse. And lo and behold, the market actually sold off and it reversed hard. Now, we use the RSI in the previous example, but it can be replaced with any momentum indicator, such as CCI, stochastic, MACD, and so on. All these indicators are derived from price, so there's no better or worse indicator. It's really about preference. It doesn't matter which one of these you want to call your best friend. All approaches are equally good, but we want to get back and focus on what matters, which is the concept of divergence. Let's quickly recap here for context before we take a deeper dive. Bullish div is when price makes two significant lows, but the second is lower, but the RSI is making higher lows. Bearish div is when price makes two significant highs, but the second is higher, and the RSI is making two significant highs, but the second is lower. Now, we previously defined divergence as a discrepancy between price and indicator movement. Note here, we've now added the MACD to the chart. When the price makes a new low, new low, but the MACD makes a higher low, we have bullish divergence, signaling that the trend is likely to reverse. This is classic or regular. You can see the black line of the price is sloping down, but the black line on the MACD is sloping up. Now, the depth of divergence is a bit more subjective. When you look at this example, we see two patterns, a bullish and a bearish. First one here is nice, but the second one does not look as promising because of the two peaks or troughs on the MACD are not as significant. We consider a divergence to be deep if the MACD crosses the zero line. When we have such a divergence, it provides a much stronger signal for trend reversal. So let's take a look and see exactly what this looks like. On this chart, we see two div patterns. First one is almost double bottom, if you will. The second example has a more defined peaking action. When we peak, excuse me, notice that the MACD line crosses below the zero line, rises back up, forms that second peak, which is lower than the first, thus giving us our pattern. And because it did cross the zero line, this means we have a higher quality divergence pattern. So now we know the basics of divergence. Let's look at ways we can approach them in a smart, methodical manner. We've discovered these patterns can lead to consolidation, correction, or full trend reversals, and that's great, but we need a definitive plan about where to enter, where to place our risk, and where to exit. Because with this strategy, we can make quick profits on small corrections and minor trend reversals, or try and capture major market moves. Now, we know that this is a reliable pattern, and sometimes this is what chart patterns see, a double top. This is what sometimes Elliott wave traders see, maybe a shortened fifth wave, but they all refer to the same thing, the divergence pattern. This is what chart pattern traders see, this is what Elliott wave traders see, and this is what we see. Most traders don't realize that MACD or RSI divergence is exactly what they're looking for. Our approach removes the subjectivity because the div pattern is well defined. So now let's talk about entry. The first is entry. Where or how do we even enter these trades? So there's a couple different approaches to consider entries. The first one is a simple enter on next candle open method. We wait for that divergence candle to close, and then we enter on the next bar or candle open. Another method is to wait for a candlestick confirmation. That's where we wait for a bearish candlestick, an engulfing or reversal pattern for short positions, or a bullish candle or bullish engulfing for long positions when we're buying the market. So now we covered entry, we have to discuss the least fun or exciting aspect of trading, but by far the most important, that is stop losses or risk management. Now, we want to keep things simple and objective. There are multiple ways we can manage risk, but for a stop loss with this strategy, we can place it just above the bearish divergence pattern for a short, or just below the bullish divergence pattern for a long. We want to give this a little bit of a buffer. We'll talk about that later, but again, we're just keeping the mechanics simple and objective. In this example here, we see that the second turning point or point of divergence acts as a minor resistance area from which price uses to retrace, and we're thus protected from being stopped out too soon. So we've covered entry, we've covered stop losses. let's get to the fun part, and that is profit targets and exits. Now, our first goal is to make a quick profit before the market turns against us. We don't want to shoot for the moon here. We don't place the first profit target too far. I found that in my own personal trading, back testing, that a wise place to place the target are at significant areas of support or resistance, or what I like to call price structure. This keeps us from guessing an arbitrary amount of ticks or points or pips. The divergence valley is a good place for profit taking. Notice that we have very clear price structure at these levels, and price is likely to gravitate towards these areas like a magnet. It's no coincidence that prices have reaction at these levels. So by taking profits at these levels, we can now profit from div patterns that result in minor trend change or correction. And we can make consistent profits based purely on this exit technique alone. But divergence, as we know, can also lead to complete trend reversals, and we want to be able to take advantage of these trends that occur, and we'll cover that in just a bit. Candles. When a candlestick reversal pattern or opposite div pattern appears, it can also serve as a good place to exit. When we have a candlestick pattern that appears close to the first take profit level, but we weren't filled or objective was not reached, it means that we might or are likely to reverse or a bare minimum pause. So that's where we can close a third, 2/3, half a position, whatever there, not wait until the price reaches the full take profit level. So let's put this in perspective. Here we see price lurched up to our take profit early, take profit level or the valley, put in a bearish reversal candle right here, right near the TP level, retraced a bit, came back to that level a second time, reversed again, but this time drifted all the way to the stop out area. So that's why it's usually a good idea to consider closing part of our position up here, not being greedy, holding out for that last bit of profit potential. Now, another great way to trade the strategy is by adding a couple moving averages. It doesn't really matter what those are. I've got an 8 EMA, which is my fast. I've got a 34 EMA, which is my slow. First look at this example shows that the candlestick reversal pattern right here was a good place to exit. And I'm certainly not complaining. If we're entering here, we have first targets here, and if we have to reverse here, I'm not complaining about that profit, but there is room for improvement. When we add that 834, we can see that price trades up, bounces from the slow EMA, and reverses, and we have a chance to re-enter the market and continue to ride the trade into ride the trade lower into profit, all by stair stepping above the swing highs along the way. So now we've seen a few examples of how to catch quick moves as well as longer trend moves. The most popular approach amongst traders regarding exit strategies is they just choose an arbitrary amount of ticks or points or pips. But to me, that's the wrong way, because as you know, every market and every time frame have different volatility. So it really makes no sense to go for 100 pips or 5 points on the S&P or $7 on a stock and so on, because volatility changes over time, and it changes over time for each instrument. So the best way to determine our exit and to keep it easier and less objective is using what we've talked about. First one is this structure, plain vanilla structure. Valleys and dips as significant areas of support and resistance, as well as candlestick patterns. Candlestick reversal patterns, when those appear close to our first take profit levels, but we weren't filled, we can close half our position, and then we can trail our stops using whatever trailing stop methodology you may use. Now let's talk about false divergences. We know that there's going to be false divergences or false setups like there are in any strategy, but how do we filter these? We know that when traders are trying to jump in a new trend, they typically want some confirmation. And we know that a trend reversal can be confirmed when we have that divergence breakout. And to many traders, that divergence is confirmed when we have minor support or resistance that is broken. So if we look at this here, we can see that this is where most traders are looking to enter, but this is where we're looking to make a quick profit. We're entering here, we're looking to take profits here, we're entering here, looking to take profits here. There's nothing wrong with this, but with this approach, the entry can be too far away from the start of the move, and the risk can be too high when compared to the profit. Remember, our goal is to limit risk. We don't say that this entry technique is necessarily wrong, but our way is a more consistent way to achieve profits. I also want to remind you that sometimes a MACD histogram could look choppy, quickly reversing up and down, implying that the market is in chop zone. And that can generate a long series of false signals. So right here, for all those out there looking for some magic holy grail chop zone indicator, you don't need it. You can use the MACD. It's free on every platform. We're chop, trend, chop, trend, chop, trend. That's all you need to determine the trend or trend strength of the market. Now, to prevent overtrading, I found a way to recognize clear divergence patterns. Our golden rule says that the signal line must be crossed by the two peaks. If we look at chart 1 here on the left, you see how the signal line crossed below the 0 line. Now look at the chart, look at chart 2 on the right. There's no crossing of the 0 line. So this means that this pattern here is going to be your higher quality trading setup. Now back to entries. Remember, our goal is to enter as soon as possible after the divergence pattern is formed. Our strategy gives a signal just after the MACD hook or turning point. Only after that MACD hook is formed, you'll recognize the second peak on the histogram. And this is where we recommend entering on the next candle open. It's a very simple and mechanical rule. But I further fine-tune this into an even more reliable method. That's by using trend lines. So when we're looking for a long signal, we draw trend line on the chart by connecting the minor highs, placing a buy stop order just above the trend line. When looking for short signals, we draw a trend line on the chart by connecting the minor trend lows. We place a sell stop just below the trend line. When price breaks the trend line, we are in. So this entry is almost the same as the quick entry technique on the next, quick entry in the next candle open technique, but sometimes it protects us from the false MACD hook when the MACD turns again and continues to fall. Here's another example, but this time to the sell side. We place a small trend line on the chart. We can enter on a sell stop or a confirmation retest of the trend line break. So let's recap everything you've learned. You've learned a high probability reversal strategy on where to enter, where to place risk, and where to take profits, as well as how to filter false setups. How do pros trade? Have you ever wondered why the market turns against you right when you jump onto a promising looking trend? Because the most tempting signal is likely a trap. As there are no more buyers to move the market, the sellers begin to dominate. As there are no more sellers to move the market, the buyers begin to dominate. Divergence masters know how to enter in the opposite direction just before a trend turns. And that leads me to this quote. Love this quote here by Max Gunther of the Zodiac Axioms. Yes, following the herd may work sometimes. Think of the 90s tech bubble, worked until it didn't. 2000s real estate boom, worked until it didn't. Cryptomania of the 2010s. But do you really want to be the one chasing new highs when you have a high probability strategy of selling them? Or panicking at market lows when you could possibly be buying at substantial discounts with much lower risk? Of course you do. That's what every trader's goal and dream is to do. When you trade this way, your winning batting average could be sub 50%. Yes, you don't have to be right 50% of the time. You don't even have to be right 40% of the time when your risk to reward is overwhelmingly skewed in your favor. But here are some additional pearls of wisdom. The less you trade, the more money you're likely going to make. We want to filter the unreliable divergence patterns and focus only on the strongest signals. We want to use a customizable indicator that can deal with this for us, where the process of recognizing the div pattern in the chart is done for us automatically. We sit back, enjoy the various exit levels, and find out what suits our trading style the best. But how do you do all this? Well, you can scout on the lower time frames, or you can swing or position trade off of the longer, intermediate to longer time frames. You can trade as many stocks, options, futures, currencies, cryptos, any asset classes that you wish, but you have to be patient. You have to avoid over trading, because remember, as we stated earlier, patience pays. Patience pays regardless of what strategy you are using in the market. But how? How do we do this? Silas, there's too many markets, too many time frames. I don't have enough time. And I understand. I fully am in the same boat with you. We don't have enough time in the day to do all this. Well, we've now developed a time-saving solution so that traders can live their lives, not worrying about scouring through thousands of symbols, dozens of time frames, and scrutinizing hundreds of charts, trying to determine if what they are eyeballing is actually divergence or not. We've now cracked the code and simplified the process. But how? Who here is ready to trade like a professional, ready to stand out from the crowd and treat trading like the business that it is? Take a swig of water here. Well, you can now do that with the Divergence Dominator Pro package because it's time to automate. The Divergence Dominator Pro package is a complete, comprehensive trading business in a box solution. Let me quickly guide you through what this package is so you can immediately see how it can benefit you in your trading, even as early as today. Well, what is it? What all do you get? It's a great question. You're going to get a turning point identifier indicator, or what I call the TPI. You're also going to get a DD Pro scanner, price action pro trading course, candlestick recognizer guide, divergence cheat sheet, the DD Pro trade journal, and the TPI fast slow line cheat sheets. But what the heck is this? What the heck is the TPI? Well, the TPI is an indicator that auto plots high probability divergence setups or turning points, locating, scanning the markets across all assets and all time frames at the same time. So let's see exactly what this looks like. This is a daily chart of IBM. You can see our bullish divergence line coupled with a bullish TPI buy signal. Here's our bearish divergence line coupled with a bearish TPI signal. You attach this to your favorite chart, pull up your favorite market, attach the TPI indicator, and bam. Here is a daily chart of the US yen. Bullish divergence line with a bullish buy signal, bearish divergence line with a bearish TPI signal, bullish TPI buy, bearish TPI sell. You can now at a glance see these major reversal points in any market in any time frame. Here's one more example, 5-minute chart of the British pound, bullish TPI buy, bearish TPI sell. Can everybody see that? The TPI in action. Now, what platforms? Well, how about Thinkorswim, TradeStation, NinjaTrader 8, TradingView, and MetaTrader 4. You can now immediately see these turning points in real time with a click of a button. But we don't want to have to locate these setups manually, do we? No. If you've been trading for some time, you know that these are very reliable and profitable trade setups. But here's the thing, manually identifying these divergence patterns are difficult. They're time consuming, especially when you analyze multiple markets and time frames on a daily basis. And that's where the TPI indicator and scanner comes into play. It automatically detects the highest probability patterns for you with the click of a button. So combined, the TPI indicator and scanner are capable of identifying divergences using all asset classes, all time frames, regardless of what style you are. Scalpers, day traders, swing traders, position traders. But aside from the indicator and scanner, I feel like the crown jewel of this package is my price action pro trading course. This is a never before released course that you're going to get immediate access to. It's a 10-part on-demand video module. My only full step A to Z training course focused on trading pure price action, how to find and identify the most important areas to even consider being a buyer or seller, completely removing the uncertainty, all by trading in conjunction with the TPI. So if you are ready to quit guessing, feel confident about your entries, remove your emotions, think like a professional, scale your risk to reward, and have a solid trading plan, then the TPI indicator and the scanner can help do this, but the PAP course jumpstarts your success even further, because we know that this is no secret. Divergence has been known and used for decades, but now not only do you get a first of its kind tool, an indicator that locates high probability turning points on your behalf, the PAP trading course has all of the solutions to help you with each and every one of these bullets that you see. Okay. You're also going to get the Candlestick Pattern Recognizer guide. This is not your standard guide. We all know that there are dozens of candlestick formations or patterns out there. This guide is short and sweet and only covers the most important patterns that you should focus on. It's a PDF that can be downloaded and printed off for your desk reference and study everything from the ins and outs, the structure, how to interpret, and much more. You're also going to get the DD Pro Divergence cheat sheet. This is great for those that like written descriptions and summaries, but can also accompany all the video modules. You're going to learn about regular, hidden, and exaggerated patterns, the differences between each, additional tips, and much more. So the Divergence Denominator Pro package, you're going to get the TPI indicator for the 5 platforms, the scanner for Thinkorswim, NinjaTrader 8, and TradeStation, the Candlestick Recognizer Guide, the Divergence Cheat Sheet, Trading Journal, and the TPI Fast Slow Line Cheat Sheet. So what is all this worth? If you're now able to profit in any market condition, if you can anticipate major market reversals and turning points in real time, if you can trade on your time, whether you're a scalper, day trader, swing trader, and you now had all the tools. You had the indicators, the scanner, trading guides, videos, and direct access to me. Your support does not end. You have access to this for life. You no longer have to guess on where to enter and where to exit. But we need to determine if this is for you. If you love scalping on nanosecond charts from dusk till dawn, you love to be stressed out and have heart palpitations, you get a thrill of blowing out accounts over and over again, you love driving to the bank and wiring money in your account over and over. If you have a gambling mindset, no clue where the market is likely headed, you're better off just flipping a coin, then this is probably not for you. But if you are ready to think like a professional trader, you are ready to remove your gambling mindset, you're ready to get serious and treat trading like a business that it is, and you're ready to kick your emotions and have confidence each and every time you place a trade, then this could be for you. And if this is for you, I have a very special offer for today's workshop attendees. The Divergence Denominator Pro package. You're going to get the TPI indicator for Thinkorswim, TradeStation, NT8, TradingView, and MetaTrader 4, the scanner for TradeStation, NT8, and Thinkorswim, price action pro trading course, recognizer guide, divergence pattern cheat sheet, and the additional bonuses, brings the total value to $4,427. But I'm very proud of this indicator, the PAP course, and all of the other educational material. I only want to get this out to those that are serious, those that are tired of kicking the tires, those that are sick of jumping from system to system, those that are ready to take action and see real results in their account. So we're not going to charge $4,427. We're not going to charge $3,000, $2,000, or even $997. As part of this live webinar special, we're pleased to offer this to the first 10 signups, a single one-time fee of $397. The offer link is seasonalswingtrader.com/pro. If Sherry could kindly put that into the chat for us. Yes, this is a one-time charge of $397. Offer link is seasonalswingtrader.com/pro. It's 90% off the $4,400. You're going to get the indicator suite, the scanner set, the PAP course, the guides, cheat sheets, all for a very low one-time fee of $397. You own it for life. You get access to all platforms. You're going to get additional enhancements. Anything we do, any changes we make to any of the platforms, you get all of the updates included. Now, I often get asked, Silas, how do you trade these setups? And the easy answer is that it depends on the setup. My overall outlook, whether it's shorter to intermediate term to more position based, what other positions I may have on at the time, and the risk and reward of that particular setup. But how do I trade these setups? I like to trade credit spreads, primarily on equities and commodities. I will also trade debits occasionally, and also trade the underlying in both futures and FX. But let me say that what or how I trade really doesn't matter. And frankly, you should never be concerned with what I'm doing or what Susie Trader or Joe Trader or Billy Trader are doing. If you have a question or idea, you can reach out at any time, and I'll be happy to answer you all day, every day. But in the end, you are in control of your own account, how much capital you have, your knowledge, your risk tolerance, and time you can personally commit. We're all different creatures. We're all at different stages of our trading journey or our life. So you have to figure out what works best for you. But I am here to support you. I love working with our members and students. So if you ever have any questions at any time, I encourage you to take advantage of being able to reach out to me and ask me your questions. If I got a couple minutes here or a minute, I want to just show you exactly what this looks like here in real time, some trade setups that we are utilizing. You can see these here. You can see these sell setups that we have on this 4-hour euro currency. We are currently long the euro currency right now. You can see reaching first profit objectives. You can see our bullish divergence line here, bearish divergence lines up here. I talk about how to trade all these setups. This is what the members area looks like. You can see the TPI indicator for all these platforms, the scanner, installation guides, and here is the price action pro course. Now, again, if you choose, whether or not you choose to use the indicator or not, I assume you would want to because of how accurate it is. But I really, really encourage, I mean, this is the core foundation, in my opinion, of trading pure price action, basic supply and demand principles. And when you combine the two of those together, trading these at areas of price structure, you are going to have a solid and sound system. You will be able to quit jumping from system to system. Here's all of your other guides, resources, and bonuses. You get access to all of these. Let me see if I can, let me check out the questions I was just granted. All right, one moment here.
Granted.
Yeah, go ahead.
I would say you were granted a question. Sorry about that.
Oh yeah, no problem. So yes, you can have it on multiple platforms at the same time. So I run, right now I'm on a laptop on one desk. Over to my right, I've got a PC. I'm running it on Thinkorswim all day, every day with my scanners rolling. Obviously right now I'm in Trading View, but I also run on MT4. I do have accounts at all of these firms here. Don't use TradeStation as much. Don't use NT as much. I am using NT for some back testing things, but I run on all these all day long. It works beautifully on TradingView. I'm guilty of looking at charts on the couch or in bed sometimes with running the indicator. But in the end, you know, it is price action. This is price action, pure in and out, right? But this is a tool to help us locate these setups. I'll show you another trade that we are in right now. We are in gold based off of the daily. You can see these setups. This is the last sell setup we had back in November. You can see the buy back in February, but we did not get the confirmation until just a few days ago. So we are long gold. You can see our risk to reward is extremely tight here. Extremely tight. We're risking just down here below these swing lows, and we're targeting up here. We have looks like a 2-to-1 risk reward ratio on the first target. Okay, these are the kinds of things that just appear day in, day out across multiple markets, as low as tick charts, 1-minute charts, 5-minute charts, to the 30-minute, hourly, 4-hour, daily, weekly, and more. Let me see. Do not repaint? No, they do not repaint. This is not a subscription. This is not a subscription. You own it for life. Yes, absolutely. You can use it to trade options. In fact, that's what I do. I think I mentioned that just a minute ago. So I'll be selling bull put spreads down here, or you could buy call options. Yeah, the link is in the chat, seasonalswingtrader.com/pro.
I'm going to put it in there one more time, and then we're going to have to call it.
Okay.
I really appreciate this
I
presentation. This was fantastic.
Yeah, I appreciate so much for inviting me. Thanks for having me on. I thoroughly enjoy this because it's something I actually use and apply. If you have questions, you can reach out to me at support@seasonalswingtrader.com. Thanks again, Sherry. Hope you have a great day. You got a wonderful list of speakers lined up, so make sure you listen to them. Thank you.
Thank you. Have a great day. I appreciate that very, very much. All right, everybody. If you have questions, you just get in touch with Silas, and he'll be following up with you as well. And with that, I want to bring our next speaker to you. We are going to see Rick Sadler of Hit and Run Candlesticks, and he's going to be talking about our road to wealth plan. And the Oh, I wanted to also tell you, sorry, Rick, just a second. If you guys have to leave early, we do have the recordings posted. You will get an email with the link to the replay, tradersexclusive.com archived webinars. And that is where you'll see all of our webinars and live events. And right now, again, I want to bring up, we're going to bring Rick Sadler of Hit and Run Candlesticks up. He's going to be talking to us about our Road to Wealth plan. And the bio that I got from Rick says, Rick is living the dream. His dream was to quit his day job and start trading for a living. And around 88, 89, he began dabbling in the market. He'd make a little money, he'd lose a little money, rinse and repeat. You get the picture. Bottom line, he says it was fun and had the thrill of gambling, but it sure wasn't profitable. So while he enjoyed the process for a while, he really expected to find one strategy that would hit a home run. And at this point, he was no further ahead financially and pretty much breaking even. So in 97, he started to get serious. He put together $8,000 in startup capital and worked to develop his own simple, low risk, high profit trading strategies. And in a year's time, he turned that $8K into $28,000. Now that was pretty impressive return until a bad trade lost him $6,500. So he took his remaining cash and went house hunting. And when he came to his senses and went back to the techniques that worked, they were easy to spot candlestick patterns, support and resistance with clear entry and exit points. And he could see the same pattern developing in hundreds of charts. And more importantly, he could enter with a low risk on a short-term trade, grab his profits, and sleep well at night. So Rick's been trading and coaching traders for over 34 years. And he's going to share these ideas that will help your road to wealth. And just as a last little note here, the test account started with $5,000, and in 30 months it reached $70,000. Now, in August of 2020, he started a new Road to Wealth account with $10,000, and it's now worth $38,000. So I want to welcome you, Rick. Let me just make you the presenter. And you may need to unmute yourself. Yeah, you're going to have to unmute yourself. Now you should be able to share your screen. Oh, was that there the whole time? I'm sorry, guys. Oh no, I think it is. You with me, Rick? You're going to have to unmute yourself. Unmute. It says you're self-muted. Okay, now you're there.
There we go. There we go.
Sorry about that. I think I was clicking too fast.
Yeah.
How you doing?
No worries.
Thanks for being here.
Oh, my pleasure. Let me get a screen up for you, and let's get a PowerPoint up for you. There we go. And let's see if this works. I'm going to try to share my webcam. Hey, look at that. All right. Hey, everybody. Hi. My name is Rick Sadler. Sherry, thank you very much. And boy, I'm going to have to update my bio. Thanks. So, hello, everybody. Again, thank you very much for being here. Sherry, thank you so much for inviting me. I truly, truly appreciate it. I want to apologize. I'm fighting what I think is a pretty bad spring cold here. So I might have to drink some water if my voice starts getting really, bear with me. And if I have to cough, I'll try to pull the headset off and as little far away from the mic as possible. So I do apologize. All right. So I want to cover something that Sherry said. She read the bio there, and something I want to make very clear here is, you know, there's no one perfect way to trade. There really isn't, and everybody is an individual, and everybody has to find their way to trade. And sometimes you go through a lot of knee skinning before you figure that out. And so what I tell, people that come to our trading room, new people, trial members, tell them all the time, look, if you find that you're struggling, stop trading for a little while. And what I mean by that is stay trading, but don't spend any money. You have to learn how to trade first. You just can't, I'm going to show you what I think is an absolute wonderful chart strategy, but not everything is about the charts and not everything is about the chart strategy. In fact, we're going to probably talk more about how my goal is to double my money every 12 months and actually end up more than that. That's what I'm going to share with you most today, but I will show you a couple of charts and I will show you what we call the 3/8 trap, which I think is just absolutely one of the best trade setups there are. But please keep in mind, if you're here to look at 9 dozen charts, you're not going to see them from me today, because I truly believe that there's another side to trading, and it's not always the chart. Okay, so let's get going here. Quit my yakking. So the road to wealth, Route 66. I'm here in Springfield, Missouri, so I used to have a Harley and I would ride parts of the Route 66 often. And so that just, I think, fits the whole talk for today. But they had a plan, they had a plan to go from east to west here. And I think with trading, you have to have a plan. I talk to people all the time that I ask them, well, what's your goal in trading? And their comeback is always, I want to make money. That right there is disaster. That kind of, that statement is a disastrous statement. So we have to get that out of our mind. We know we want to make money, but you need a better plan than that. And so that's kind of what I want to work with today a little bit. Sherry mentioned my trading account, both of them, both Road to Wealth accounts. And this past August 2020, I did open up a new account for $10,000. And as last month's statement, it was up 285% in 6.5 months. Well on the way to more than doubling the account. In fact, I've already tripled the account. Now, I'm not, I can tell you right now, my statement is not up on the website yet. And I post my statement up there so everybody can see the statement from the brokerage company I use. And you'll see that last month, I didn't do that great. In fact, every month has been a winning month, but last month it's going to be down. So welcome to real life trading. You don't have winners all the time. Let's see here. Oh, I want to remind you of something that if you're interested, please go to our website. Just go to the home page, hitandruncandlesticks.com, and just scroll down to the bottom. On the 16th of this month, and for the purpose of any recording, this is April the 7th, so April the 16th, in the evening, we will be holding a live giveaway, and it will be for a complete Falcon computer with monitors and a stand, to hold 4 monitors and 4 monitors. We'll be giving that away. So please just go to that website there and you can sign up. Okay. All right. I am going to jump into a chart here for those that want to see charts really fast and just don't want to hear somebody yakking. So let's take a look at that. First of all, let's point out what the 3/8 trap is. And let me explain this chart just a little bit. And let's see, I have 30 more minutes. Let me write that down. 1:30. Thanks, sorry. Okay, so what is the 3/8 trap? First of all, this black line right here, that's the 8 exponential moving average, and we call that the T-line for short. Some of you may have heard that term T-line in the past. That's it right there. This green line, This is simply the 3 exponential moving average, but it's measured on the highs. So if you set up your 3 exponential moving average, more than likely, whatever program you use, it will automatically come up on last price or the closing price, you know, the current closing price. What I've done is I've adjusted mine to the highs, so it reads the highs of the candles. The program I use here, by the way, is TC2000, and this is the main 2 indicators for the 3/8 trap. Let me just point out these green dots. This is what we call the Trindicator, and these red dots right here, this is part of the Trindicator here. And this just shows us, are we in a bullish trend above that, or a bearish trend below those red dots right there? That's all that does. And that's just the 50 period moving average. Okay, so I'm a big believer in following price. I'm also a short-term swing trader. So for me, if I was to buy this in this area right here, more than likely I would be out somewhere in this area right here. I'm not a long-term trader. My definition of short-term is overnight to 15, 20, 25 days maybe. More times than not, I might be out inside 5 days. So I'm simply looking for a price pattern trapped between those 2 moving averages. Whoop, 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 whoop. Easy does it, Rick. There we go. Okay, can't hit that scroll button now, can we? So what I'm looking for is price action like this, where we rally up and we put in consolidation or a buy pattern, something like that. And there's the rally. Let me make that bigger. There we go. We rally up and then we consolidate. All this is a reason to be a buyer. You could also be a buyer on a small little breakout. Not sure I would chase that gap there at all, but on a breakout, that might be a trade. And then what we're looking for is the rally up. Now this happens to be a live chart. This in no means, in no way do I mean this to be a buy. When I say live, I just clipped it a little while ago. And you can see here where VLO, we're putting in that 3/8 trap right now, and we've popped up. In fact, we've gone from a low to a high to a higher low. And let's do this. Go right across here. Probably should have used a different color. There we go. So when we start breaking out of this high, this could become a buy right here. So this is exactly what we would look at for a chart. It's pretty simple. I don't use any indicators, just simply price action, candlesticks, chart pattern, things like that. And this strategy happens to be the 3/8 trap strategy. Whoops, I should have had this slide a little higher, my apology. One other thing that we do is whenever I buy a position or sell a position or make an adjustment on a position, I also send that out to our members and trial members as well via, it's an app, it goes to your smartphone. So, you know, and these are some of our favorites, you know, the solar, the pot stocks, electric cars right now, they're about as hot as can be. And whenever we buy something, within seconds after I buy it, it's sent to your phone. Whether you're in the trading room or not, you could be out golfing, fishing, wherever, doctor's office, and get an alert. So you don't even have to be in the trading room. But on any position we take, not just these. Something I believe in very strongly is to be a chartist. You can, like I say, I don't follow any indicators. Indicators is simply, all indicators are derived from price action and volume. So I never could figure out why it would make sense to follow any kind of indicator. Why don't we just go to the source? So let's follow price. And as far as trending or anything like that, we always want to be trading in a trending chart. So as long as the chart's trending, then we're going to start looking for price action that that gets us into the position. So you see a rally up, you see bulls being interested in the chart, they pull back, and then what we're looking for is a reason to be a buyer here. That's where we might look for the price action, a candlestick signal or a grouping of candlestick signals near a supporting area, and that's how we make our money on the way up. Simple trading, it's absolute visual, no indicators involved. Outside of the moving averages we use, and what that does, it helps with our entry is what it does. So candlestick formations and price action, pretty much that's the same thing. Learn to recognize fear. What I do is I use the VXX chart, and I trade this often. This is why I use it. And if I see fear in VXX, then that helps me determine whether I should be buying or not. Fear in VXX would be a sign that it's moving up. For example, again, this is April 7th, 2021 at 2:06 Eastern time. And right now, VXX is showing no fear whatsoever. So the market tends to be bullish because of that for me. This one right here, know when the water is too deep. Look, this is important, okay? This is seriously important. And I see too many times new traders get out there and all they want to do is trade. Just give me that stock. Just tell me where to buy it. Tell me where the stop is. Let's just trade. And it doesn't work that way. It really does not. And I know that might not make sense to some folks. Some folks might say, what the heck? If you can double your money, just tell me what you're trading and I'm going to follow you. It doesn't work that way. It just does not. And you just have to take my word for that one. But so know when the water's too deep. Know when the market is choppy and not good for you. I should have said this a minute ago when I said, you can't just follow somebody. There was a few weeks ago where the market was so choppy, everything I did turned to crap. I mean, it just choppy, and ended up losing money. That was the reason my account's going to be down for last month, was because of that choppy market. So learn to recognize when the water's too deep. And when the market is trending or not trending, and it doesn't matter whether it's trending bullish or bearish, at least it's putting in a good trend. When it's moving sideways and it's got all this up and down on choppiness, this is what drowns people. And you don't want to be one of those people. You don't want to be one of those people that just totally drowns, okay? Learn when to trade and when not to trade. These two right here go hand in hand with this one right here. Just because you wake up one day and you want to be a trader doesn't mean you have to trade every single day. Just because you pay for a membership somewhere or you're paying to use your charting package or whatever, look, that doesn't mean you have to trade every day, okay? You probably have mayonnaise in your refrigerator, but you don't use mayonnaise every day, do you? It's the same thing. You don't have to trade every day. And I think that's very important. Trade your chart. And whoops, I should have, my bad. Apologize, I should have taken that out right there. Always trade a trend. Bottom fishing never got anybody anywhere. Over my 34 years, and I've been one of those, by the way, in the early days, I've never bet anybody that actually made money buying stocks off the bottom. I've never done that. Sure, you win a few, you'll lose more. You'll win a few, you'll lose more. you'll drive yourself crazy. But in the end, all the successful traders look for a trend, and they trade with that trend. Now, a trend to you and a trend to me might be a little bit different. That's okay, as long as you stick with your trend. I trade something that we call PBO. It means nothing more than a pullback opportunity. It was just that chart that thing I just drew over here a little bit ago. We want to be in a trend. We want to see price rise. We want to see price pull back. And then what we're going to do is we're going to look for a buying opportunity in here. And the buying opportunity will be made up of candlesticks or price action. Could be one candlestick, could be a grouping of candlesticks that gives us that feel good entry. And for the purpose of our 3/8 trap, this might be the 8 exponential moving average right here. Then what we're going to do is you have that 3 exponential in there, and when the 3 comes down and we get price trapped in there right there, that's what we're looking for, or a very slight breakout of that 3. Again, we're going to look for that price action reversal pattern. All right, I think this is one of the most important things there is, what I'm going to go over right now. If there's nothing you take away today from this, and just this right here, I would encourage you to take this. I would encourage you to jot this down, copy it if you can on the screen, and just think about it. And we're going to go through some numbers here. Now, Sherry mentioned it on my bio here. In 2018, January of 2018. By the way, I can kind of tell that I might finish the presentation before we're at the end here. So in January of 2018, I opened up an account for $5,000. In 30 months, that account reached over $70,000. And what I'm sharing with you here is exactly how I did it. Pay attention to the charts, watch price patterns, trade that 3/8 trap. It rocks when you get the hang of it. Don't expect you're going to go out this afternoon and knock a bunch of buildings over and be an ace trader. Work with it a little bit. I'm in the room. I answer all kinds of questions about it. We even post on our social media, Facebook, Twitter, YouTube. You'll find stuff. So don't be afraid to ask. Well, let me grab some water here. Again, I apologize, this cold I've got, man. So what I ended up doing is I ended up closing this account and I opened up a new account in 2020. And this was in 30 months, by the way. I opened up another account in 2020 to show that small money can make big money. You don't have to have a lot of money to make money in the market. 2020, I opened that up with $10,000, and it is currently over $30,000 right now. So not bad in, what are we looking at, 7 months now, I guess. So we're headed to it. I've already doubled it, and now I'm heading to, well, I've actually already tripled it. Now I'm headed to quadruple it and just keep growing the account. And I'm going to show you exactly how I did it here math-wise, and I think you're going to be surprised. I want to point something out here. A lot of people, traders, maybe if some of you have been to my webinars, you've heard me say this when I'm in a grouchy mood. You might have heard me say this kind of thing, especially at the end of a webinar. You put your chart up there on the website, and everybody's watching your charts, and the only questions they ask is, you know, what moving average is that? It's like, really? That's your question? The next, you know, the other thing that everyone wants to know is, where do you enter a chart? A little better question, but still a rotten question to ask. The next rotten question, and then this is one of the most worst questions, and I know probably everybody's probably wondering, where's he going with this? When you go to webinars, make sure you ask the right questions. And, you know, what moving averages do you use means diddly do. It does not matter. It's my chart. Make your chart, and you'll be a better trader for that. Believe me, you will be. And I'm not in a grouchy mood right now, by the way. But I'll hear people, where's your target? If this is your entry, let's paint this green. This is your entry. Where's your target? And the next one is always where your stop is. Everybody wants to know that. Well, truthfully, your entry is pretty much where you see the buyers. Your stop is how much can you afford. That's important. And the target, you know, I see things and I hear things like this all the time. This is some magical target up here. Price moves up and you're tickled pink. You're just excited. You're ecstatic. What difference does it make if that target is there? Because if the candle does this, the next candle, you're going to tuck your tail and run anyway. So what difference does it make if there's a target up there? And I know everybody's saying, wow, that's something I've never heard before. Yeah. So all you need to see is a path to profits, a path. So I always want to trade at least a 2-to-1 risk reward ratio, and you know, 1 risk and 9 reward would be wonderful, but it doesn't mean I expect to get 9 times. Does not mean that. And I'm going to show you here how I take my profits, and I think this is truly, truly important. Okay, so let's say you have an account size of, where's my pen here? There it is. Let's change that to blue. Let's say you have an account size of $10,000. And again, I urge you to copy this if you can off the screen. In fact, I should probably send it out to people. I could do that. All right, so let's assume you have a $10,000 account size and you want to double it inside 12 months. I think that's a pretty fair. I think that's a pretty fair want. I think most people would be tickled pink with that. Actually, I think most traders would probably be ecstatic if they could get half of that. But let's go ahead and let's shoot for this doubling, okay? So remember, we're trading the 3/8 trap. We're waiting for a very specific setup. The 3/8 trap helps with that entry. We're waiting for good price action, and we want to see a path to profits. You've got to be able to see that path to profits there. So I happen to think there's 243 days in a month or in a year to trade. Now, you may think there's less. You might even think there's a few more. That doesn't matter, okay? This is just what I think, and I've built in some days off. I've built in a little sick time. I've built in a little bit, you know what, I just want to take the day off. So to me, 243 works. Like I say, you can put whatever you want in there. So just take $10,000 and divide it by 243. Very simple. And what's going to happen is you're going to come up with your daily goal. Okay, your daily goal of $42. Now, can you imagine? I mean, even to I bet I've explained this no less than 1,000 times. And even still, when I write this number in here, it blows my mind away that if I just saved $42 a day for 243 days, I would make $10,000. That's amazing. I think that's truly amazing. So let's just double our money. Let's don't try to make $20,100. Let's not go for more money. When you get the system down, you'll find that that will actually happen because you're trading more than one position. Most people do trade more than one position. So now this is net. You have to net this. So you could have, you could actually have a loss, a loss, a loss, and then all you need is one winner that beats that loss by $42. That's it. You're on your way to doubling your money. Now, we know that there's 5 trading days in a week, so we're going to just 42 times 5, and we're going to come up with $210, $210, okay? So not every day. You might not make $42 every day, and I mean put it in your pocket, all right? You might not do that, and that's okay, because some days the bear does get us. It absolutely does. But by the end of the week, if you are a trader worth your salt, if you're playing with good risk reward, you're playing with good charts, good trending charts, you're playing a good solid strategy, then I think you should be able to pull this off. I really do. So at the end of the week, you're doing great. There's about 20 days per month. Some months have 21 days. Excuse me. You should end up with about $840. Yep, I had that written down, had to look. $840 a month. And guess what? That's going to equal your extra $10,000 a month, and that's going to give you your $20,000 right there. That's how you're going to double your money. And boom, there we go, 20K. And this is the exact formula that I used to double my account in 2018, actually go from 5,000 to 70,000. This is the exact formula I use currently with the Road to Wealth account to go from 10,000 to currently at 30,000. So you can see that smaller accounts can, I apologize. You can clearly see that smaller accounts can get there. Now, let's go to the next slide. Here's one of the problems I want to talk about that I see let's see, we want that right there. Here's one of the problems I see with new traders or struggling traders. You're all over the place. You're trading charts breaking out to new highs. You're trading charts that are coming off the bottom. You're trading charts that are doing something I couldn't even begin to comprehend. You know, you're trading this, you're trading that, you're trading long, you're trading short, you're trading a 5-minute chart, a 30-minute chart, an hourly chart, a daily chart, a weekly chart, yada, 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 yada. You're all over the place. Stop that. Just stop that right there. Right there, you'll probably earn more money just doing that one little thing. Just stop it, okay? So stop trying to trade everything under the sun. If it's not working, it's not working. If you've been trading for 15 years and you're not making enough money that you're not happy and satisfied, obviously what you've been doing for 15 years has not been working. So stop it. And this is usually what I find people do. New traders just don't know any better. So just stop it. And focus on one thing. And look, you don't have to focus on, say, the 3/8 trap. You don't have to focus on, you focus on any. I'm not sure who the speaker was before me, and honestly, I don't know who the speaker is after me. But if you like what they did, if that made sense to you, if that light bulb went off and went, wow, that makes sense, that's what you should do. You should do what makes sense to you, okay? And simplicity, do what makes sense, and focus on that one thing. Don't try to trade everything under the sun. All right, let's talk about the 3/8 trap. And let's talk about how we might take some profits. So this is a what a typical 3/8 trap chart might look like right here. I'm gonna always want the Trindicator to be green. I'm always gonna want that. I don't really like to buy long when the Trindicator is showing me a little red. And I really don't like doing it. I would rather pay a little higher for the price if I need to. I know they always pull back, so I'm never worried about that. And if we look at entering the chart when, say, price is in this area right here, now we can clearly see that we kept on running up. In fact, it's still going, isn't it? I mean, if you don't see any candles on here, we just have the 3 and the 8. But because they're trending, it's clear that price is still up here, isn't it? Or still going. Very clear. But me, I'm likely to be taking my profits off here, or some of the profits. Let me explain now. So, whoops, pen. So, say your goal is that $42, all right? Say you have a $10,000 account and you want to double your money. So let's just work with this. So what I'll do, I'll buy a position, and then when this doubles, so as price starts moving up, when this doubles, so this would be $84, what I'm going to do is take half off the table. Just take it off. But my target's up here. Who gives a poot where your target is? When's the last time you went to McDonald's and went through the line and said, here's your target, now give me a hamburger? That's never worked out. So what we want to do is we want to take our profits off. Remember, we have a plan. It's not all about let's make all the money we can. That rarely works out for people. It rarely works out. So let's do this. We're buying the position. We're going to sell some of this position when we get to a double, or even a little more. I mean, if the price action is looking good and the day looks good and it's still climbing up, I'll hold it till the end of the day, and then I'll take half the money off the table. And then what I'll do is I'll raise my stop a little bit. And as it moves up, and what happens a lot of times, especially in a good bullish market, what happens a lot of times is you'll find this $42. Remember, you took 84 off, so now you should only have 42 left. What you'll find is this will actually climb, and you'll end up with another 84. And you'll move up, and you might end up with 160 on that second piece. We'll go ahead and close that out. But my target's up here. Who cares? Again, targets don't make your account. Money makes your account. This is the exact formula. I mean exactly the formula, what I've done to double the account. I urge everyone to tweak it, try it, see what you think. Now, for those with bigger accounts, this all changes. For those that have a $30,000 account and you want to double this to $60,000, just to go to that cheat sheet that we had, fill it out, and figure out what your average daily goal is, your average weekly goal is, your average monthly goal is. Trading is it's a game for a turtle. It's not a game for a rabbit. Game for a turtle, okay? So very important to remember that. Man, I'm already running out of time here, aren't I? Some basic rules. Buy only in a trend. This is so important. I can't even count the people that I've run into over my years that you've got a stock that's trending down, and then it puts in some great big bullish candlestick, and they get all giddy. They can't stand it. They have to buy it only for it to move down even further. That is not a buy signal, by the way. I hear now. I better not get into candlesticks. This is a clue. It's not a buy signal. The signal is when you have strength above it. Okay, got me going here. So what we're looking for is we're looking to go above it, and then we're looking for that PBO. And right there would be the T-line area, that 3/8 trap. That's maybe what something you're looking for, that pullback opportunity. Now we're looking to buy. We're not looking for this down here. We're looking for the follow through. Buy on positive price action. That's just what I have right here. Buy near a visual buy point. Hey, Sherry, I know I'm coming up on my time. Please just give me a 1 minute or 2 minute heads up, or if there's questions, things like that, okay? Thanks. Buy near a visual buy point. The visual buy point can be support. It can be candlesticks maybe that has put in a decent bottom, things like that. The 3/8 trap is a perfect visual buy point for me. I'm going to look for that 3 exponential like that. I'm going to look for the T line. That's the bottom part of the trap doing that. And we're going to look for a buy right there. So if I was to buy it, one thing I might look for, which is not every time, is that if we start moving back below the T line, that's where my stop would be. Again, that's not 100% every single time, but that would be a good place to start. Make sure you can see a path to profits. You know, if you're looking at a chart and a chart is moving up, boom, 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 and it moves down, and you see a great setup right here. But if this right here is 2%, why in the world would you want to take that trade? You know, make sure you have a good path to profits. Now, if you're not concerned about that, then that's fine. If you see something else up here that might give you a reason for it to attack, that's okay, but make sure you can see it. Just never forget about this. Make sure that you've got a good path to profits. Profit into strength using the goals. That's what we call this. You might hear in our trading room, man, I just took 3 goals off the table. Well, that means somebody, they're trading their goals. You might not even know what their goals are, but if they say they took 3 of them off, that means they took, we've been talking about $42, so they took 42 times 3 off the table. That's how you do more than double your account. If you have multiple positions, you know, you can have, you can meet your goals in one trade 3 times. Well, what if you had 4 trades on that met your goal? Even if you had some red situations going on, you can end up with multiple goals per day or per week. And that's how you get to where you more than double your account. And
hey, Rick.
Yes, ma'am. Is it time?
I have a couple of questions for you if you can take them.
I can.
You can't? Okay.
I can. Yes, please. Please. Please.
Somebody asked, Raj asked, I see sometime you also add 17 line.
Mm-hmm.
And I'm not, that was about right around 2/3.
That's okay. I know what he means there.
Okay.
The 17 EMA is what he's talking about, and that is our Trindicator.
Cool.
Oops. Oh, yeah, right. Whoop, 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 whoop. Right here. See where we have the red dots, and we have some green ones mixed in there too. But you can see when it's red. This is probably not the best chart to show for the negative Trindicator. But when we have those red dots, I'm not interested in buying. I'm only interested in buying when we have a trend with the green dots working. So for instance, here on 3M, you can see the green dots working in there, and that would be a perfect place to buy. You can see the Trindicator working. This would be a good place. Trindicator working. This would be a good place. Trindicator working. That would not be a good place because we don't have a buy signal. However, this might be a good area. So
how do you get those dots on there?
It's something, first of all, I wish I could say it's something unique. It's not. It's just the 17 exponential moving average. I use TC 2000, and we just figured out a way to do it.
Okay.
It's a combination of the volatility stop set with I think it's 1010 settings. Anybody that's familiar with it, you'll know what I mean. 1010 on the settings, and just change the color, bullish to red or green,
Okay.
bearish to red.
All right. And I have another one from Charles who's asking, how is the trend assessed?
How's the trend assessed? Again, what I usually use is the 17 rising. One of my other favorites is the 34 EMA rising. And there's nothing wrong with having the 50 rising. But all I want, and by the way, this is exactly how my chart looks on the screen. Well, that's not true. I almost never have the 3 on there. That's too complicated for me. I know it's there. I know it's in our scans built in. Same with a rising 34, a rising 17. If I was to use a naked chart, it's built into our scans. So I'm just looking for that rise. So something simple might be for the 17 here, something simple might be you want the past 5 days to be greater than the past 10 days, greater than the past 20 days, something like that. So you
Okay.
get that trend.
All right. So now everybody can get in touch with you. They just need to go to that home page that I have pasted into the chat.
Yeah.
And you've got several free trials on there.
Great. Thank you.
And you've got a giveaway.
Remember, please sign up for this. Here in just a couple weeks, or less than that now, we're going to be giving away this Falcon computer system. This is actually the same computer that I use. And truly the value of it is $3,200, but it's only there's $200 in there for you if you want to upgrade to say a 27-inch monitor, and there's 3 monitors, to go toward that accessories. But it comes with everything you need to get your computer going. Nice computer stand, 3 monitors, the computer through Falcon
Awesome.
trading system. Yeah, it's a rocket computer. So
awesome.
Yeah.
I really appreciate you being here with us, even though you weren't feeling 100%.
I feel good now compared to what I did. It's just that lingering thing going on.
Just got to get over it.
Yeah.
So I appreciate you being here, and I'm going to look forward to seeing you in the future as well. So
thank you,
everybody, look forward.
Thank you, everyone.
To an email
appreciate it.
From Rick, and have a good day, sir. Thank you.
Thanks. Bye.
Bye. All right. All right, everybody. And now we've got our third speaker coming up. It's Mark Helweg from 3X Options. And he's going to talk to us about why this hedge fund manager is telling friends and family to exit stocks. What? Okay. Mark Helweg began his trading career as a runner on the floor of the Chicago Board of Trade at the age of 19 while in engineering school. When he turned 21, he leased a seat on the floor of the exchange and traded in the Treasury bond futures pit for a brief time. After leaving the exchange to focus on engineering school, Mr. Helweg pioneered early quantitative trading models for a local hedge fund. And during his early years, he also developed the first algorithm to model price in terms of objective value known as value charts. And that's its registered name. Over the past 20 years, Mark has served as head of research and senior strategy developer for several award-winning hedge funds. He authored his first book, Dynamic Trading Indicators, with the John Wiley & Sons Marketplace series. This book was recognized among the best investment books of 2002 by Barron's magazine. And he has been a frequent contributor for CNN Money, Pre-Market, And he also speaks internationally on technical analysis in the stock, futures, and Forex markets. And he also is going to grace us with his knowledge and wisdom today. So let me make you the presenter, Mark, and you may need to unmute yourself.
Hey, Sherry. All right.
Hey.
Can you hear me okay?
Good to see you. Yes.
Good to see you too. Okay.
Thank you for joining us.
Yeah, my pleasure. Thanks for having me. Can you see the opening slide, I assume, and hear me okay?
I can. If it has your picture and the fact that you're the senior researcher at Top Trades Tools,
Yep,
toptradetools.com. Did I?
3X options.
Did I do that right? 3X
yep,
is the same? Okay.
Yes,
I'm going to mute myself and you take it away.
Okay. What time do you want me to wrap up by? I guess around
well,
20?
we're about 5 minutes. No, we're about 10 minutes off the mark here now. So I need you to go for about 40 minutes and then 5 minutes for questions, if you don't mind, and you wrap up.
Okay.
Thank you.
Thanks. Yep.
Okay, great.
All right. Welcome everyone to why this hedge fund manager is telling friends and family to exit stocks. And by the way, as I say that, I'll tell you near term right now I'm bullish stocks, and I'm going to show you one of the most powerful indicators to time that. So I've got my finger on the trigger, if you will, but I'll show you a very powerful indicator where you can, I believe this is one of the best indicators out there to know how to time the stock market. So let's go ahead and dive right in. Now, it's important to understand that trading involves a high level of risk and therefore is not suitable for all traders. Before deciding to trade, you should carefully consider your trading objectives, level of experience, and ability to tolerate risk. Also, we're talking, we're traders, we're interested in trading here in this webinar, but I'm talking from an investment standpoint as well. So understand that Top Trade Tools 3X Options, we are not registered investment advisors, and we're not registered with the U.S. Securities and Exchange Commission or FINRA. So that's important to understand. And then CFTC Rule 4.41 simply states hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. So I don't think that's going to deal too much about what we're covering today, but I'll cover that anyways. Now, today we're going to talk about a couple of things, including Warren Buffett's research and it really his indicator that he watches to talk about when he believes a top is imminent in the stock market. And I'm going to show you how you can see when the big Wall Street funds are dumping their stocks, which is the best indicator out there in my mind for timing potential big sell-offs in the stock market. And then let's talk about what is the hot investment potentially over the next 10 years or 5 or 10 years if stocks start to stumble. And so we'll cover all three of those in this webinar. Now, this begs the question, so a couple of very basic questions here. How much downside exposure do we have in the stock market right now is obviously a big one. How much upside potential do we have in the stock market as well? And that's a very real question as well. What are the risks and benefits of just using the buy and hold strategy going forward that the investment industry encourages us to use? What are some of the other investments we could consider if stocks enter a bear market? What are the risks of doing nothing, because doing nothing is, in fact, a decision? Now, before we begin, let me just briefly talk about my background and why I'm interested in this information and how I analyze the market. So basically, my career has been 20 years plus in the hedge fund industry. I've been blessed to be a part of some Star Search winning teams. So we won Star Search twice over the years, and also received national recognition by Futures Magazine as one of the top managers for that year as well. So we've been very interested in the markets, and I think at the end of the day, no matter what you trade, our hedge fund was long-term trend following about across 8 different asset classes, if you will, 8 different sectors, maybe it's a better way of saying it. And so we were always watching stocks, the stock market and the stock indices in general, because that at the end of the day is pretty important, and that is something that you want to keep an eye on, if that makes sense. So regardless of what you're trading longer term, or what we did, we were always watching the stock market essentially as the benchmark out there. So that's my background more or less. I focused my entire career on quantitative or technical analysis, developing indicators to forecast prices and trading strategies to actually generate buy and sell signals. Now, understand again, this is not a statement that's rude. It's basically a factual statement. I'm not your investment advisor. I don't want to be your investment advisor, because that's actually that's a real certification, and that's more a sales position, I think, than anything else. But that's not what I am, and I come from obviously more of a trading and hedge fund background. So my sharing of the information today is just more or less sharing my notes and sharing the information of why I think we should be very careful and look to get out of stocks here, potentially in the not too distant future. Now, this webinar contains my observations about where the stock market might go. So that's very important. In terms of what this is. Before taking or making any investment decisions, consult your investment and tax advisors, especially your tax advisor. So it's very important to do that, because if you make a big investment change, it might create a huge tax consequence that you may not necessarily want, or cause you to consider a different strategy in how you defend yourself or protect yourself if we get a big downside move in stocks. Now, understand that the financial system is not designed to get your investments out of harm's way. So it's not designed to do that. Your financial advisor is most likely not going to call you to tell you to get out of stocks. Okay, that's not what they do. So I've never received that call before. They don't do that. They don't track it. And then frankly, I don't think they really know how. So, and it's not easy, to be honest with you. Even very good indicators are going to be wrong at times, but timing the stock market is really not easy to do. So they don't even try to do it. But the downside of that is we are subjected, if we buy and hold and don't, take defensive action when the financial storms come, we are subjected to fairly significant risk in our stock investments. So just understand that. Now, it's a little unusual to leave your most valuable asset for many of us out there in the storms. So if you have obviously a larger stock investment portfolio, they're asking you to leave it out, just leave it out in the financial storm, and that could subject it to substantial losses. It typically will. It's not what we normally do. Like when I lived in Florida, if we saw the threat of a hurricane, we'd always board up our windows in our house, because you could incur significant damage if you don't do that. Or when I lived in Colorado, the hailstorms were not uncommon there, and so we would move our vehicles inside so you wouldn't have thousands of dollars worth of damage. But yet the financial industry wants us to leave our stock portfolios out in the storms. I'm not a big fan of that. So let's talk about what we can do about it. Now, you should also play out different scenarios and decide what you can and can't live with. Now, the reality is a 30 to 50% drawdown in the stock market during a recession is not necessarily unusual. So that's kind of normal. So if you're close to retirement, you say, well, I don't want to lose 50% of my stock portfolio. Just be careful. So you've got to be proactive and understand that if we do get a recession and the economy takes a downturn at all, that could be something within the cards. It's happened many times before. And lastly, consider both that I might be right and I may be wrong about the stock market longer term. And I'll even throw an argument out there in a minute of how I could be wrong and how that there may not be the issue that I'm worried about. I'm trying to think creatively about this, but I believe that there's a really good chance that I'm right in terms of the stock market heading lower. Now, let's look at the stocks right now. If you look at the statistics since the mid-1920s, the stock market's been up approximately 74% in a year. So 3 to 4 years approximately, we have a bull market, and that's what we've come to expect. And we are in the midst of one of the longest bull markets in history. I think it's probably the longest now, going on to where we are today with the start in 2009. I wanted to show this visual because to some extent, this visual really shows that we've been spoiled we'll call it the last 12 years or so. And the fact that we haven't seen much of a sell-off. The worst down year was really not too bad. And then we had a big sell-off last year, but we bounded back by the end of the year with the coronavirus sell-off. But that was painful, obviously, when it first happened. But coming back, it's now erased that. So last year, we'll call it 2020, ended up positively. But we saw something similar in the 80s and 90s where it was a bull market that really was unusual, because if you go back in history, you tend to see larger down years where it could be 10 to 20%, larger drawdowns that could reach 30 to 50+%. We saw an 80+% drawdown with the NASDAQ. That means loss from peak levels in the year 2000. And so it's possible, it's definitely possible for the stock market to get hit hard if there's any kind of a recession. So this is a reminder that this is not necessarily usual activity over the past 12 years. This is a bit unusual. It's been a lot easier than it normally tends to be. We must remember that stocks can experience huge losses during and what we call lost decades. So what is a lost decade? It's basically when the stock market has a fairly sizable downturn and it's 10 plus years to recover. We saw that in, we'll call it the early 1900s. We saw that in the after the 29 crash. We saw that in the 70s. We saw that in 2000 to 2014 approximately. So there's been a lot of lost decades over the years. In fact, this next visual will help you see here in a second how they really are not that uncommon. So this chart shows that the market crashes have occurred numerous times throughout the 19th, 20th, and 21st centuries. Recognizing their frequency can help provide a better sense of the real risks of investing in the stock market. And by the way, almost every time before a crash, you have people saying this time it's different, but it really never is. Lost decades can be just as harmful as crashes, in my opinion. So this is what they look like if you look at the S&P 500. So S&P 500 had a period of about 20 years starting right around 1906, where it was flat, and then after the 29 crash, another 26-year period before it hit new highs, and then 14 years in the 70s and 14 and a half years from 2000 to 2014. So not uncommon to find these, these years or these periods where the previous high is not eclipsed until many, many years later. Now, the thing also that you hear people say is the stock market's always gone to new highs. And I don't think it's very helpful because, we don't have 25 years to wait around sometimes for a new high. And that's a lot of years that we get no return out of stock. So if you're in it right now at our current highs and it tanks, then do you want to wait 10 years or 15 years for it to reach new highs? It's a possibility. We just need to keep that in the back of our mind. And so it's something that we definitely want to factor in. Now, Warren Buffett indicator, let's talk about that and how he tends to view things. So not too long ago, there was the Berkshire Hathaway quarterly meeting, and this was a snapshot of an opinion or a little article online that says Buffett's indicator is alarmingly bearish, and this year's Berkshire shareholder letter could reveal why. And so this is interesting, and what he looks at as a measure of what we'll call being overvalued. So Warren Buffett will indeed double down on his bearishness. Consider the story told by the ratio of the stock market's total market cap to US GDP, which is gross domestic product, the so-called Buffett indicator. It got its name 2 decades ago when Buffett said the ratio is probably the best single measure of where valuations stand at any given moment. It's an interesting way to look at things. So this takes us back about 70 years, and you can see where we are right now is pretty crazy overvalued. So it's compared to where it's been historically. So this is something we've got to watch. And the reality is that the stock market can become overvalued. We saw that in 2000, and it had a really big correction after that. So that's not unusual activity. This is another snapshot, a different chart here that shows more of a measure from like a linear regression norm, if you will. But even with this chart, it's still very much overvalued compared to where it's been historically. And lastly, this is a variant, Warren Buffett indicator variant, using the Wilshire 5000 to the gross domestic product as well. So this is also overvalued compared to what we've seen going back for many, many years. Now, a second measure that's worth looking at is called the Schiller Pe Ratio. So another measure of stock market valuation. Again, the Schiller Pe Ratio. This metric was developed by Robert Shiller and popularized during the dot-com bubble. So this one, when he argued, Robert Shiller argued correctly back in 2000 that equities were highly overvalued. Well, it ends up he was right. It's most commonly applied to the S&P 500, but it can be and is applied to any stock index. When the Schiller ratio is high and other valuation methods are high, it's usually not a bad idea to trim your equity holdings and invest elsewhere where markets are cheaper. So this is probably what Warren Buffett, I think, would say to us right now. I think Berkshire Hathaway was in about 35% cash last time I looked. They're doing that because they think the big correction is coming and they can buy stocks really cheaply when that does happen. So this is the Schiller Pe Ratio. That was a few months back, but you get the idea. It's pretty overvalued, especially compared to like the 29 crash. Not quite, last time I saw it, not quite as much as the 2000 level, but still fairly overvalued. So this would argue again, that we're very likely to see at some point a fairly sizable correction or even a bear market. Now, let's move to a couple other things that I think are problematic longer term, and let's talk about printing money. Here's an interesting statistic. Did you know that 1 out of every $5 in circulation were printed in 2020? So that is a really alarming thing to some extent. For a country that's over 200 years old, 1 out of every $5 bills was printed in 2020. Now, the Federal Reserve has become too comfortable printing money to solve all of our problems. Here's a graph of a money supply graph, and you can see how it spikes up here in 2020. And the thing about it is, we've taken extreme action, or the Fed has, for something that didn't really pan out to be the real threat that we thought it was. Now, we know that some lives were lost, and that certainly is not something we ever want to see, but the reality is it wasn't the global killer like the Spanish flu was in the late 1918s or whatever. So that was the fear, and we certainly were prudent to be careful with this thing before we really knew what was happening. But it ends up that it really hasn't moved the needle too much if you look at the death rates per age group over time, at least with the statistics I've seen. So to me, the problem here to some extent is we've spent a lot of gunpowder here to fight this, and from a pure investor standpoint, it makes you wonder how much more powder the Federal Reserve has. So the Federal Reserve balance sheet has exploded in an effort to combat both the mortgage meltdown and the coronavirus pandemic. This cannot continue forever. And so this chart really speaks volumes. This goes back almost 100 years, really about 100 years. And you can see that the Federal Reserve balance sheet was over $1 trillion all the way up until, under $1 trillion all the way up until about 2008. So that was about 100 years. And then all of a sudden, when the mortgage meltdown, we know that was massive atomic bomb in our economy, and we understand the extreme action there. But I think this next action with the balance sheet exploding again of the Federal Reserve going from under 4 trillion to about 6.5 trillion, that could be problematic over time. You haven't seen the same thing happen in many Asian countries like China or South Korea, Singapore, Japan, etc. So this is what we've done. Is it the right move? I think that maybe it isn't, and it'll have consequences over time. Now, lastly, bubbles are often characterized by crazy financial behavior. So this is something we were looking at back in 2000 when obviously we were managing our hedge fund back then. March 22nd of last year, we see the Michael Jordan, I think this is a rookie card, sell for $48,000. April 19th of 2020, sold for $51,000. May 8th, sold for $96,000. May 21st, $97,000. December 5th, $150,000. December 6th, $151,000. And then January 30th, $738,000. So going from $50,000 to $738,000, what you see in bubbles a lot of times is where money people don't treat it like money anymore. It's just whoever paid $738,000 for Michael Jordan's card is obviously, I think it's extremely overbought. I don't think they'll ever get that price again in their lifetime. But this is what you see in bubbles. You see like the tulip mania many centuries ago and other things like that, just crazy, spending like that. Now, the other thing also, I don't know if you guys have seen this, but Tesla, within the last 2 months, I think it was actually so overvalued. Tesla company was more valuable than all the other car companies on the planet combined, and they only make 0.5%, 0.5% of the cars around the world. Now, think about how crazy that is. I love Tesla. Certainly Elon Musk and everything they're doing is very exciting, but even he said, hey, this is overvalued, and that's hard to justify. I mean, more valuable than Toyota, Honda, Nissan, BMW, Mercedes, Lamborghini, everything. More valuable than all those companies combined that's not something that's sustainable, and it's not. It just is not more valuable than all those car companies combined, especially only manufacturing 0.5% of the world's cars. So now let's ask the hard question. When should you get out of stocks? If we say, okay, we can see the writing on the wall, there are warning signs out there. When should we get out of stocks? How do we time this? And there is actually a very intriguing answer to this question. Here's one idea using an innovative tool to time the stock market. So this is how you can see when the Wall Street firms dump their stocks. Large institutional funds, Wall Street firms, rule the stock market. These firms account for 89% of the daily volume in the stock market. These firms spend millions of dollars on research every year. They have access to information that you and I will never see. We will never see their research, and it's hidden behind, very advanced biometrics and security systems. But thanks to a specialized new indicator, we can now see their trades. So this is the New York Stock Exchange. This is the cornerstone of the stock market. It has the highest market capitalization of any exchange in the world. And if you're a big player in the stock market, you're typically going to almost always be a big player on the New York Stock Exchange. The average daily trading volume on the NYSE typically ranges between 2 and 6 billion shares. Every day, the New York Stock Exchange has approximately $200 billion in trading volume. The trading on the NYSE often sets the tone for the entire stock market. The NYSE created a data feed for us to see what all the NYSE traders and investors are doing in real time. It's called the NYSE tick, a valuable measure of short-term stock market trading activity. Now, if you're familiar with the tick, this isn't what you think. All right, I'm going to show you something very interesting about the tick. So this is what it looks like. If you haven't seen it before, this is a 5-minute chart of the SPY, which is the S&P 500 ETF, and this is what they call the NYSE tick index. This reading, this EKG looking indicator, it's really an index down here, has nothing to do with this S&P 500 up here. So usually most indicators you see in the subplot are driven by the price action of the market on the top, but this is a case where it's actually not. So this is a completely different reading. What this is showing us is the real-time, we'll call it motivated or active buyers and sellers on the New York Stock Exchange. So in this current format, I find that it's actually pretty difficult to read. Now, you can learn to read it. Some day traders will use it and they can use it effectively, but it's very hard to know sometimes when it's just noise or when it's really telling us something. But if you look at all this information just as a whole, it oftentimes looks very noisy, and it's very difficult to read. Now, it turns out that hidden within this NYSE index could be some of the best information about the stock market. And here's what I did. So I built another indicator that mined, if you will, aggregated the NYSE tick index to create this. What is this? This is what I call the Wall Street tracker. This is aggregating a longer term picture of the NYSE tick index. And you'll see last year work like a charm for alerting us to get the heck out of the market or take protection, measures early on in the coronavirus sell-off. So this was within 5% of the high, and you can see here that it really protected you well. If you had this information, you could see that the Wall Street firms were quietly dumping their stocks early on because they had massive concerns about the potential of the coronavirus. And so having this information, in my mind, is one of the best tools or best timing tools out there in the stock market. Now, this can give and will give false signals over time, but it can be incredibly effective when you expect like a big financial storm potential out there in the stock market. And it's a great visual. You can see that when we see aggregated buying, or we can see, we'll call it, stronger selling power over a period of time as well. And the visuals is very, very effective. So how do you know if you got out, like for example, last year? And by the way, side story on this is a friend of mine called me up, and we talked about something completely unrelated, but he asked me what I thought about stocks as we closed our conversation, and I told him I would get out of stocks. So this is, and just you never know what people actually do, but he actually emailed me like a couple of weeks later. Go fast forward, like later on around this time frame, and maybe even after, well into March, just say, hey, thanks so much. You saved. This is a minor miracle. I did get out of stocks. So after we spoke, he did actually get out of the entire stock, his portfolio, and saved himself a lot of downside exposure. The hard question is for most indicators is, well, if I get out, where do I get back in? That's a beautiful aspect of this tracker. You get back in when you see buying again. And so we started to see in early April that the buying started coming back on the stock market, and sure enough, it started to really take off. So where are we now? And let me just, I want to pop a chart up here to show you. This is where we are right now in the stock market. And so there was a brief period and just a few days ago where we had selling, and then we popped right back up to buying. So overall, for the last couple of months, it's been buying. So the stock market has been going up really since about, end of October. You can see a lot of buying, but overall, mostly persistent buying in the stock market over time. This was a false signal we had recently at the end of March, but right now it's pretty strong buying. So this is a great tool to potentially tell us, if and when the big boys or the big funds out there are selling, because again, they're never going to share their research, but they could, we could see what they're doing with this powerful indicator. So how can you potentially protect your retirement account from a crash? Using the Wall Street tracker, you could consider going to cash when the Wall Street funds dump their stocks, like we saw in the previous last year, 2020, the pandemic, global pandemic, coronavirus meltdown. So that's one idea. You could put on some protective measures. You don't need to be extreme like Berkshire Hathaway is now at 35% cash. You could go part of your money to cash. You could, do a number of different things. So it doesn't have to be all or nothing, but this can be a very valuable tool to take protective measures, in your stock portfolio. And the thing to remember too is make sure you understand the tax implications, because you don't want a big unexpected capital gains tax for stocks with a low cost basis. That's not a surprise you want, and that might change the way you actually approach protecting your portfolio. But when you think about it, just with that coronavirus sell-off, you're talking about a $50,000 account losing 15,000 plus of value, or a $100,000 account losing 35,000, or $1 million account losing 350,000. So then when the Wall Street funds began to buy again, you can enter stock. So here's the enter, it turns green again, and this could be a measure you could use to get back into stocks. Now, I don't necessarily recommend using this all the time. What I mean by that is the best application, I'd say, of using this is when something extreme is happening in the world. Like, for example, the mortgage meltdown. That was floating out there as a potentially really, really big problem, right? When the stock market started going down before. And so using this in conjunction with that, or something major happening in the world, is really the best application, I would say. If it's just business as usual and you look across the world and you're thinking, okay, nothing too major is happening. Like for example, we had the dot-com bubble. We saw some craziness happening there with Y2K and things like that. So if that's out there in the world, this may be even more powerful, as a measure. But you could take protective measures when you see red, but sometimes you're going to get false signals. I found over last, we'll call it 10 to 12 years, it's helped a lot more than it's hurt, but it will have false signals over time as well. So the next question is, well, if I do get out of stocks, what are some things I can consider also looking at longer term? So this brings us to our next interesting study, and that is there's a trigger event that's happened 2 times in the last 50 years, and now it's actually happening again. This creates a potential strong investment opportunity for us. This is the 3rd time that this trigger event has happened in the past 50 years. This trigger tends to happen maybe around once every 25 years, and now it's happening right now in 2020, 2021. This means that stocks could be in trouble over the next couple of years, and those who are close to retirement really should pay attention. This could be an interesting alternative. Those who have money in stocks need to pay attention as well, because stocks may not be the go-to investment for the next 5 years. So let me explain. This is the ratio of commodity prices to stock prices, and it's at one of the lowest levels we've seen in the last 50 years. And when we've seen it at incredibly low levels historically, many times commodities have started to really take off. And now guess what we're seeing? We're starting to see commodity funds really start to jump. They're already up 100% off their lows. So commodity funds have gotten crushed over the last 10 years or so, and commodities in general, and now they may be the hot investments to go to over the next 5 to 10 years. So if you have money in stocks, you say, well, I'm nearing retirement, and maybe I'm going to use my money. I'm not going to put it at risk. Well, you may just want to go cash. You may just want to get it out of harm's way, or part of it out of harm's way. If you're somebody who says, I still need a return. I don't want a lost decade where we're at the same level we are now 10 years from now or 15 years from now. That'd be really bad. I need my money to grow for me. If that's your situation, you might want to consider looking at some of the commodity ETFs, because commodities could be the hot asset class over the next 5 to 10 years. So we're starting to see aggressive buying in commodities right now, and I'll show you some examples of that. We'll go to live charts here in a second. Now, let me just quickly touch on this for those of you asking, how do I get the Wall Street tracker? We created a special service. So for investors and traders who are interested in getting access to the Wall Street tracker to see what the Wall Street funds are doing, we've created a way for you to see the Wall Street tracker and what the Wall Street funds are doing in real time, so you can see when they start dumping their stocks. Our new Wall Street Tracker service will show you when big funds are buying or selling on the New York Stock Exchange. Now, we can't see their research, but now thanks to the Wall Street Tracker, we can see their trades. You will not find this information with your broker. You won't find it with Schwab, TD Ameritrade, or Fidelity. You won't find it in the Wall Street Journal. This is our custom indicator that we've designed that's available at smartmoneyreport.com. Now, here's how you can get immediate access to the Wall Street Tracker. So this is what it looks like, but let me just quickly run through this. We put together a bundle here of different services. And by the way, these prices are massively slashed. I'll show you the promotional price we're doing right now, but this is updated daily. So my trading desk guys are updating the Wall Street Tracker every day on the website. We also have an ETF research report it's on demand. You can download it, talking about what to do for the next 5 years. So where to potentially go for the next 5 years. Smart Money ETF scan also is one of those things that gives you the ability to see what ETFs are being bought up right now. Lastly, the portfolio calculator is a really neat calculator to show what would have happened had I mixed like my commodities stock investments last 2 times as trigger events happen. So normally all this goes for 2,900. We've slashed it down to 297. So you get all of this years, 12 months worth of service for 297. And this, by the way, rolls to a $29 a month service after 12 months. So this is only found at smartmoneyreports.com. So if you want to access this, Sherry, I don't know if you want to post that link up there, but it's www.smartmoneyreport.com/new. If you have any questions, feel free to give us a call, 859-963-3445. Now, let me just touch on, you get the ETF strategy report. I think it's a 20+ page report. It talks about how commodities are incredibly cheap compared to stocks. The long-term cycle would favor, and we're already starting to see buying on the commodity ETFs. It would favor that these are going to be pretty popular, I think, in high demand in upcoming years. So here's what the ETF research report contains. The trigger event defined, third time in 50 years, smart money ETFs to consider for the next 5 years, how the smart money ETF performed in the past, trigger events, research supporting the smart money ETF selection, chart pattern research, ultra rare chart pattern could make huge returns, and then achieving access to special assets using exchange traded funds. And then specifically, I review 3 different portfolio examples, and then you also get the Excel portfolio simulator. So all of that's included. The smart ETF scan is also something we put up there. Which ETFs are ranking higher, which ones are being bought. This is updated weekly. It's really more of a scan, I would say, or a ranking than an alert, but tracks the biggest stock ETFs and commodity ETFs and others out there as well. You can see which ETFs are being quietly accumulated and consider potentially, which ones you buy based on that. So again, the promotion here, I'll just throw it up one more time. It's www.smartmoneyreport.com/new. All right, let me quickly go to questions here. Sherry, I don't know if you want to share some questions, but I'll throw up a chart here.
I have a question there assigned to you. So Charles wants to know which time frame is best to track this NYSE tracker, i.e. 30 minutes, 4 hours, daily, weekly, etc.
So I would say daily, and here's what it looks like on the website. So we update it daily. We just gather the information. We gather it, every 30 minutes. So this right here is what you would see on, once you log in. So you can download this. This is updated by my team every day. After today, it's going to be updated. Right now, we're seeing pretty strong buying. So right now, there's no need to panic. But if we start to see, things getting worse out there, and you start to see a lot of red, the first red reading you see is where you should consider taking defensive action. And you're going to get false signals over time. Just understand that. But I believe that this indicator could be fairly effective with if we get a real storm out there, like we did with the coronavirus. And so this is giving us, again, just a reading of what the big funds are doing. So so you want to look at daily. You don't want to go back and forth with 30 minutes, but at the end of the day, is it red or is it green? Is really
excellent.
Yeah.
And I put the post up there again, but give me that phone number again. The URL I put up there, and I'm looking for. Oh, I got one more here.
Here we go.
Available on TOS platform or just Top Trade Tools?
So this is a you don't have to have it for this service right here, the Wall Street Tracker service. You don't have to install anything. So this is where you go up to the website and just check the readings of when it's green and red. And so that's what this is really for. This is not an indicator that you install, if that makes sense. If you're looking for something like that, you can certainly give us a call, 859-963-3445, and we can help with that. But this right here is a service just for anybody. You could be a Schwab or Fidelity or anywhere else.
Nice. Excellent.
Yep. So last thing I'll throw out there was GSG. Let me just, this is I'll show this monthly ETF, and you can see how cheap, this is Goldman Sachs commodity. You can see how cheap it is now compared to where it was, back in 08. So very, very inexpensive. And this is maybe showing us a little bit of the potential of a commodity fund, going forward. So that's the last thing I'll just throw out there.
That's a lot to take in. I appreciate it very much. Everybody should go to the smartmoneyreport.com/new. And I think we do need to use the www. So it's www.smartmoneyreport.com/new or call 859-963-3445. I really appreciate you being with us here today, Mark. And I hope we get to have you back again in the future. So
happy to be here. Have a super rest of your day. Thanks for having me.
Thank you. You too. Bye now. All right. We're going to bring up our next speaker. Our last speaker for the day is Paul Lange of Disciplined Trading Strategies, LLC. And Paul's been with us before. We appreciate him coming back again. Paul started Disciplined Trading Strategies in August of 2017. Disciplined Trading Strategies is a site for traders and investors. He runs a very popular day trading room and also publishes the Long-Term Trader, a portfolio for hands-off long-term investors. He also provides a ton of free information on the DTS free stuff page, and we'll be giving you that link, and assistance to new people on his website. And the best seminar program for those interested. Well, probably almost the best seminar program. Paul is a very experienced trader, investor with 20 plus years in the trenches every single day. He spent many years at Pristine Trading as the senior instructor and trading room moderator before opening DTS. The concept is not to run a business, but just have fun providing a serious place for traders, both new and experienced. So with that, I'm going to turn it over to Paul and mute myself. Take it away, Paul. You may have to unmute yourself. Yep, you're self-muted. There you are.
Hi, everybody. I got it. Let me get my screen up here. How's everybody doing today? I know I can't really see you, so give me 1 second here to get my screen, and we will get underway.
I'll pass it over when they're coming.
I should be live. No, I'm not live. Are we good, Sherry?
I'm still seeing mine. I made you the presenter.
Yeah, it's yeah, here we go. That's funny. We just did this dry rehearsal a couple hours ago, and now it's not doing it the same. I didn't change a thing. Hang on.
Let me see.
Well, let's try something else there. Are you?
All right, let me take it back.
You're seeing the crude slides there, right?
No, I'm not seeing your screen at all.
Okay, hang on. I think I got it here. How about now?
There we go.
Beautiful.
I can see you now. Perfect.
Hey, did that come off my time? I spent 3 minutes getting my screen up. All right.
I'm sorry, but that counts against your time, sir. No. No, last call of the day. You take your time. Let me know when you need to throw things up there, and I will do my best to comply.
Did you get my email with the links on it?
I did.
Okay, you can use that then. That's good.
Okay. Yep.
Okay, great. All right, hi everybody. I don't want to bore you with going through personal details about me. You can go to my site if you want to and read about me. And besides, it probably doesn't matter much because you're going to listen to me or not listen to me for the next 45 minutes and probably decide if you like some of the things I have to say or if you don't. And that's a good thing to do, actually, because you're all here for some particular reason. It has to do with making money. Maybe you're looking for a shortcut to make money. You want to follow somebody. Maybe you want to learn on your own. But whatever the reason is that you're here, one of the real keys you have to remember is that you need to eventually pick a thing to do, someone to follow, a mentor. I run into too many people who are just what I would call kind of seminar junkies. They keep trying to learn, but they never ever really apply anything that they learn. So I am very laid back. I do not ever try to talk anybody into doing anything with me. I have a huge site called the Free Stuff page. And Sherry, if you wouldn't mind dumping that out there now, that'd be great. It is what I'm calling the greatest collection of free information out there anywhere, of useful free information. There are probably sites that have more useless information and definitions, but this is some real useful information. I do that for a couple of reasons. I really want to give traders a chance to learn this on their own if they want to. And I'm even willing to get together and talk and meet with you if you want to bounce ideas off me, have me review some trades, whatever it is. I'm happy to do that because I tried to do that when I first started, and I respect that. And I also think that eventually for somebody who does want to become a student or to follow me, the best student is somebody who's already kind of tried everything and realizes, okay, you know, I'd like to get some help, rather than somebody who thinks they know it all from the beginning. So that's the reason I do all that. I'm going to go to this first slide here, and I just want to give you a couple introductory things, and then we'll get going. The first part of this, because I know a lot of you are perhaps not familiar with the topic or newer, I wanted to make sure everybody's on the same page. So I do want to take the first maybe 15 minutes and just kind of discuss some of the basics. So some of you may be bored with that, but I assure you the last half of this will be a little more exciting. If you like charts and some trades, we'll look at some of those, and I'll show you some examples of things. As it says there, one of the things I want to point out is that DTS, Discipline Trading Strategies, I call it DTS, it's my company. Whether I say me or DTS, it's the same thing. But DTS, it's not just day trading. Today is about day trading because that's the topic I chose. It's a focus I kind of want to make for this year for people. But first and foremost, really, that everybody is concerned about is a longer term investing, longer term trading, taking care of your long-term savings. So I want to show you a couple slides on that real quick, but I just want to point out that it's not just about day trading. For me, I like longer term and I like day trading for income. Some of the things I want to talk about today, if you have a bad impression of day trading, there's no need to really. I know a lot of people picture really fast-paced scalping, have to be quick, buying and selling in seconds, never leaving your chair. That is nothing like what I do. As a matter of fact, those people that are in the trading with me, I usually leave for a couple of hours and let things play out without me watching them, rather than standing there and trying to micromanage things to my detriment. So maybe some of you can relate to that. Before I go to the next slide, I just had a couple of jots here I wanted to make sure I hit on here. Oh, I hate to tell you something else too. I do not have any special deals, offers, promotions. I don't do that. There's never is a sale on anything at DTS. I truly am committed and take pride in helping develop traders that want to be traders. And like I said, there's a huge free stuff page. And I never have any kind of sale because I don't want to talk anybody into doing anything. When you're ready, you know, you'll come see me. If you can make it on your own, that's great. And I don't believe in trying to coerce somebody into doing something. The things that I have that you do pay for, they're on the site. When you're ready, come take a look at them if you want to. But very simply, I have a day trading room for day trading. I have a long-term letter that I'll show you in a second here. And then I also have a seminar program for those who want to learn how to do it themselves. Because one of the things I'll talk about today is, as you know, either you can just kind of get the trades, day trading or long-term, or you can learn to do it for yourself, or both at the same time, and that choice is up to you really. I also want you to always use common sense when you're listening to people, like in arenas like this. And I don't want to step on any toes. I don't listen to prior speakers, and I'm not ever referring to anybody. But I want you to keep in mind that, you know, the market has been around forever. It's billions of dollars that transfer hands, you know, every whatever period of time. And certainly there are winners and losers in the market. But I don't want you to ever think that you can take super quick shortcuts, that there's some magical tool on a chart that's going to be this magical indicator that's going to work, that it's as simple as saying that this is what support is and that's what you buy. Those simple concepts just don't work, at least not well enough to make money. There's no magic piece of software. I'm sorry, there's just not. If there was, I would use it. Every day, my job, day trading and in the long-term account, is to make as much money as I can. And along the way, I am the great opportunity to also show people how to do that, and sometimes to get paid for showing people how to do that. So that's a great spot for me to be in. But I would do whatever works. If you told me that standing on my head when I hit the mouse button to execute a trade would increase my profitability, I would do it. So I have nothing against any of these things, but I have been around a while. I sit here and stare at charts every day for the last 20 years. And if there was something I felt would help beyond what I do, I would use it. I think there's a lot of fallacies out there about what works and what doesn't work. And I'm just a very straight up person. You ask me, I'll tell you the truth, whatever it is. So with that, let me go to this next slide, because I just want to bring up the fact that everybody is first involved with long-term. And again, that's not what today is about. But I want to just point out a couple things to you. There's this fact that's been out there a long time that people don't seem to like to mention or acknowledge. And that is that 92% of mutual funds do not beat the market. You can look that up. It's a Standard & Poor's study. They do it every few years. They just don't. And it's not because there's dumb people running the funds. They're not. They're some of the smartest people. It's because there's billions of dollars under asset, and they just can't move that fast. But what you can do, though, is if you simply take your own stock trades, either by learning what to do or by following someone who knows what they're doing, you can do great. And by the way, I never ever pick on financial planners. Financial planners, hopefully you can see my arrow here. Financial planners are great people, but they have a different job. They're going to say, okay, here's how you split up your money so you can plan for retirement. And they're going to consider the stock market risky. The market is not risky. It should not be. At least when you do it properly, it's not risky. So keep that in mind. Long-term trader letter, a DTS, it does very well. It's based on unique stock selection. It's for stocks. It is doing great this year so far. It's profitable every year I've been doing it naturally. And it's based on great stock selection. And also there's a balance in there. And I always make money when the market drops. I can't promise you I will if we drop tomorrow, but I always have. I have a very open bias as to what's going to happen. I follow what's actually happening, not what I think is going to happen, not what the world thinks is going to happen. If you do that, you'll find yourself in a lot of trouble. It's not about being right, it's about making money. If Sherry, if you have the long-term trader link, if you want to drop that, it's just a little description that tells you what it's about, and you can look that over at your leisure. So let's get on to what today is about, and that's about day trading. I want to divide this into two sections real quick. The first section, you see this little guy sleeping here because it's going to be a little more boring. What is day trading? Truths and myths. Who can or should do it? What is required? I'm going to fly through that as fast as I can so that we can get to the end so you can ask questions. And so I have a little more time for the second section, which most of you will enjoy more. And that is looking at some results, looking at day trading examples, obstacles you may think exist for you, how to do it. And I have a kind of surprising slide in here. And I'll discuss that when I get to it. So let's go through this first section. What is day trading, etc. What is day trading? It means you're simply buying and selling stocks in the same day. In the very simplest concept, it goes like this. If you're long-term, what do you call it, long-term investing or swing trading, whatever, you may buy 100 shares of stock XYZ, and over 2 weeks, it goes up $2.50, so you make $250. Nice job. As a day trade, we buy 1,000 shares of stock XYZ. Over 2 hours, it goes up 25 cents. We make $250. It's just kind of fast motion is what it is. Now, I'm making it sound very simple, of course, and in essence, it is that simple. We tend to make it complicated. The math is easy and makes sense. But a couple of questions you may have right off the top of your head. You say, well, 1,000 shares of stock, doesn't that cost a lot of money? Well, yes and no. I'm going to talk about that at the end when we talk about obstacles. But naturally, the more you want to make, the more capital is typically required, but it may not be as much as you think. The second question is, isn't that risky to have all that stock? And the answer is no. Actually, day trading in every definition, every sense of the word, is less risky than investing because you can always exit whenever you want to. The market's not closed while you're day trading. And it doesn't matter really how many shares you have, you can exit whenever you hit the limit that you want to consider to be your limit. So there's no risk the way I look at it in day trading. Naturally, you can lose money, you can make money, but there's no risk involved in terms of something happening that's out of your control. Some myths. Day trading for market professionals only. No, that's not true. This is a big push I wanted to make last year, and I actually had this whole thing going where I really wanted to kind of push day trading just for the common everyday person. The person at home with the kids, the person working a part-time job. You know, everybody pictures day trading like some big market professional thing. It doesn't have to be that at all. Now, I literally was ready to do this a year ago right now, and the coronavirus thing came. And I decided I didn't think it would be a good taste to do this because I didn't want people who were maybe out of a job or something turning in desperation to try to make money trading, because it's not a smart thing to do. You need to step into it slowly. And that's why I really want to push today, and actually I'm pushing a DTS for the first part of this year, is to just start off part-time. I hear so many people say, well, you know, this and this is happening, and then I'm going to do this, and then I'm going to go to start trading full-time. I don't think that's a good idea. It's a lot of pressure. It's better if you are in a situation where you have even one morning, 2 mornings free a week, is to get in there and start trading for some extra income. Learn how to do it, get comfortable with it, and then the decision to go to more and more day trading time or to even go full time is an easy decision because it replaces your other income rather than all of a sudden one day saying, okay, I'm going to retire or I'm going to quit and here's what I'm going to do. I don't push people to do that at all. I think it's a bad idea actually because the pressure makes it difficult. Whether you're doing it yourself, the trades, or whether you're following somebody, it's still tough. As a matter of fact, anyone can start trading tomorrow by following someone in a trading room, something I'll talk about. In other words, one of the obstacles we'll talk about is, well, what do you need to know? Well, if you want to start off and just follow somebody, you can just start off and follow. I have a trading room, you can come in and follow. I'll talk about that in a minute. You can also learn to do this for yourself eventually if you want to, or you can do both at the same time. The best candidate to do this, believe it or not, is somebody with no experience, and I mean that sincerely. I have trained market makers up here. I have trained 2 market makers on how to day trade. They're difficult to train. Stockbrokers are hopeless. Doctors are tough. The best person is somebody who is just your average everyday person that has an open mind. There's nothing special you have to have in your background. As a matter of fact, most backgrounds people have hurt them when they learn to trade, and it really applies long-term or short-term, but let's stick with short-term for right now. Best candidates are people with no experience, so that's not an excuse for you to not look at doing some day trading. Myths. Day trading requires great knowledge about the market, stock fundamentals in the world and US economy. Absolutely not. As a matter of fact, not only is it not required, it's actually detrimental. It's actually detrimental to look or to try and factor this into your thinking. This is always a tough sell for me a lot of times to get people to understand this. I'm going to be talking about this a lot more on Friday. Friday, and Sherry, if you have the link to the intro event, the end of it says member only event intro. This Friday, if you become a member at DTS, and it's to be a member at DTS, it's not an expense, it's not a cost, there's no credit card, you don't need your name, you can make up an email, but you'll get emailed information, you'll get invited to special events, and you'll get educational emails. That's all that happens. I very rarely send out any kind of a sales email. I only do so occasionally because people ask. But if you become a member, and that link you can, if you become a member, you will get invited to this Friday's event, and it's going to be a half-day seminar. It is actually the first seminar that is given to people who pay for the DTS seminar program. I invite everyone to this first one. It's great information. It's not sales at all. It's all great information, but it's simply a lot of things that I don't want to take up the Saturday. It's not going to be the deep technical concepts. It's going to be a lot of peripheral stuff. But one of the things we'll talk about is why it is actually detrimental to even look at or consider the concepts of fundamentals, economy, news. All these things often trick people into think that they're working, but they don't. They're actually very detrimental to look at. We look at the results of the news, the fundamentals, the economy. The results show up when people take action on a chart. That is what it's all about. There is no other way to do this, period. We can't even agree to disagree. The next myth, day trading is risky. Well, chewing gum is risky if you're an idiot. Don't be offended when I say idiot, because sometimes I'm an idiot, but it is. By all definitions of risk, day trading is safer than traditional investing. As a matter of fact, your risk is always defined and adhered to. You want to risk 20 bucks? You can. Day trading requires large amounts of capital. Well, this is true and false. Certainly, the more you want to make, the more it requires. But you'll be surprised how you can make great income or even a living from a fairly minimal amount of capital. Now, there is something called the day trading rule. We'll talk about this more in just a little bit after I go through some trade examples. But there is a way that you can get in there part-time for a minimal amount of money and make some really good income. We'll talk about that in just a second. I want to just get into and keep going through the basics here. So there's the basics. And again, I'm kind of plowing through this, and I understand that if you have questions, if you, Sherry will ask toward the end, and I will have time to take your questions. I'm good till what time? Till 4 o'clock, right? So we're doing good on time. And also, Sherry will also give you my email, and I will gladly entertain anybody who has questions. You can email me if you don't get them answered here. Feel free. And if you actually have something you want to talk about, you can also set up a time to talk with me. I'm happy to do that with you. So part 2 here is going to be looking at some results, day trading examples, examples, obstacles, how to do it. So let's go on from here. So let's take a minute here. This is this week. Now, people who know me, there's probably people here listening to me that have, known me for months, years, maybe even more than a decade. And whenever I do an event, I always make it a policy to use trade examples from the last couple, 3, 4 days, always. I don't believe in going back to, boy, here's this great trade from the summer of 2018 or something like that, because that's stupid. This is what I do every day. And yeah, I can have an off day. And if I have an off day or two right before an event, I'm going to be in trouble. I'm usually lucky. But I always use the last couple of days. So I'm not pulling out some great day, to show you. This is just what we do. And this is what's posted in the trading room. Now, this is the DTS trading room, my trading room. Every day I get in here, we focus on the morning only. And these trades that you see, they are posted and discussed ahead of time, and all these numbers are given to people ahead of time. This is just a summary at the end of the day. So for example, Monday, I only did 1 trade. How boring. I'm a very boring trader. You could fall asleep in my room. I'm a very boring trader. I did 1 trade because you know why? Why did I only do 1 trade? I know you guys can't talk with me, but think about it a second. Because there's only one thing that set up the way I wanted it to, that did what I wanted it to do, that I felt that I had good odds in taking. And that was Cody. It was a short first thing in the morning. It's 1 trade. The reason there's 3 lines is because it was sold in 3 different increments right through here. So it's one entry. Entry was under 908, stop over 916. It's a very liquid stock. Anybody who wanted to trade this could easily jump in. It was discussed for pre-market. Everybody knew what I was looking at. It was on my screen in the camera. If you wanted to follow along, you could have. If you didn't, it's either because you chose not to, or because it was your first day and you didn't know how to hit the button on your trading platform. The trade, 2/3 of it was done by 10 o'clock. I walked away for this last one. The last one was sold a little bit after 1 o'clock. If you notice, the last part of the trade gave back profit. The biggest profit was right here, 2.1 R. and add a $500 risk amount, that would be $350. 2.1 hour would be $1,000, over $1,000 if the whole trade was there. But since a third of it was there, it was $350. You notice then the last part of it gave back some money. Why would you ever give back money? Well, obviously the point is to maximize your profitability. And for targets, I'm terrible at taking targets. I'm probably better than you are, but I'm terrible at taking targets. And I kind of split it up. So naturally, at the end of the day, I wish I would have taken this here and made more money, but this also could have fallen a lot more, and I possibly could have made more money. This is a short, so I'm making money when it falls. So I try and maximize my target taking, and I do a fairly good job at it. But usually the last part I let go for the home run, and sometimes the home run turns out to be giving back some profit. Sometimes it's a home run. So that was the only trade that day because nothing else set up the way that I wanted it to set up. Trading is about odds. It's about having the odds in your favor. I could go on for a whole nother presentation about this. And by the way, if you become a DTS member, I do presentations like this every couple of weeks. And there's a calendar. Sherry, could you post the calendar out there for them? It's the one that ends in calendar, of course. And you'll see the events are scheduled on my website.
Let me grab
Free
it.
events. Thanks. You got it? You do have it?
Let's see. Yes, I see calendar. Here we go.
Okay,
I'm grabbing it right now.
Thank you. So that is where you can find out about the free events, and also on there are the events for the seminar students, and they're clearly identified which is which. So you can see the upcoming events. We get together every other Monday to do a little scanning night. So it's just good information. Like I said, you're not going to be hit with any kind of sales stuff. I don't do that. Matter of fact, you have to beg to sign up for something. I'm just joking, but I don't make it easy. So that was Monday, and we were done. The strategy here is based on a 60-minute major resistance area, and the entry is on, that was a typo actually, it's a 1 minute secondary, that's a total typo. It's a 1 minute secondary sign of weakness. I just took it right from the room and there's a typo in there. So then we go to Tuesday, the next day. Tuesday I did 3 trades. Notice that they were all entered before 10:15. I focus on the morning. Sometimes there's a trade that's a little later, maybe up to 11, 11:30. That's really where I want to draw the line. Occasionally on some days, if there's something special going on, or if we have a special gap that occurred or a special market situation, I may say, hey, I'm coming back at lunch to take a look at things. The room stays open generally because I'm usually managing out the things. So Monday MRO, very early, was a long trade. I'm actually going to show you the chart of MRO and show you what I did, so you get an example of exactly what this is like. It's a very liquid stock. No problem getting the shares you want, even if you're trading $1,000 risk or more, no problem getting shares. At 9:45, I shorted J Blue. Why did I do these trades? Well, I did them because there was an exact setup that I look for. I have several setups I like, and I go through my lists. I'll show you that in a minute. And I look for the best of the best setups. And this is why I like stocks. I do trade futures sometimes, but the problem is with futures is there's one chart, there's one setup, and naturally you could look at futures and gold and oil, whatever, but you still have a limited variety. With stocks, I have a list of 300 stocks that are very, very high volume stocks that basically you could trade most any time. And then every night I scan a list of 1,000 stocks that are, they're good for swing trading and maybe trading after the opening minutes for the most part, but there's a big variety, and I look for what I want rather than making myself conform to a chart that I don't like. So J Blue was a short, and then Oxy was a short, just to show you the unique, stock situations. Again, I don't try to be an expert on what these stocks are, what they do, but I believe I was long in oil and short in oil at the same time, and they both worked very well. That's just understanding and reading a chart. Now, I sometimes sell in 2 sections, sometimes in 3. Oxy was designated as halves, so it was 50-50. J Blue was thirds, but the second, third one all at once, same thing with MRO. So each of these had 2 different exits. You can see how the money adds up, boom, 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 boom. The big winner of the day was, well, kind of J Blue and Oxy both together. The last trade was exited at 12:58. And I'm sorry, J Blue the last part of J Blue was held right till close, and it was a nice winner. Oxy 12, almost 1 o'clock. And again, for most of this day, I'm not at the screen. I left the screen yesterday, I think right after J Blue took a target. And then I was, I come back and I let the room know I'm here and I'm gone. They talk among themselves sometimes, but the important thing is when you're day trading, your goal is not to be entertained. It's to make money. It's a business. You're there to make money. You hit it when it's your highest odds moment to you. Now, by the way, I like the morning. It doesn't have to be. You personally could find your best trade setups at lunch or after lunch. That's up to you. I like the morning. There's different ways to make money. What I teach people, you could be trading any time of the day. My personal favorites are in the morning. There are morning reversal times that are very effective in helping to guide trades. A lot of good things happen in the morning to me. And, we're done basically by 10:30, 11 o'clock. I walk away, I leave some trades open. I put, you put automatic stops on them and profit areas, and you walk away and you let them go. And like Jay Blue, the last part of it went right to close when I exited into close. So there's the last couple of days. I'm not hiding today. Today was a double the goal day. To me, the goal is 1 hour a day. One risk unit a day. I'll talk about what that is in just a minute. It's just that I prepared this all last night, and since this is at 3 o'clock, I didn't have time really to add a lot of stuff. So today was a good day as well. Let me show you what you can do with this. Where do these trades come from? Here we have MRO, J Blue, Oxy. If you're in the room, and again, I'm trying to just explain to you that even for somebody pretty new, and you're afraid of day trading, the biggest thing you have to be afraid of in my room is the bad jokes. And some people I'm sure are laughing on the screen right now. I can't see you guys type, but I'm sure some of you are laughing if I have some room members here with me. But that is the biggest thing you have to be afraid of. Now you'll see on a slide in a minute, it says 95% of the time. I can't deny that occasionally something comes up kind of out of nowhere. Sometimes a room member suggests something. And most of the time I don't like it because I'm very particular, and I'll tell them, okay, fine, I don't like it. But once in a while something comes up, and it may come up kind of quick, and you may have to scurry if you want to get into it, and maybe you can't. But 95% of the time, everything is discussed ahead of time. We are day trading, so I don't want to call it slow paced, but it is kind of slow paced. It's boring. Where do these selections come from? Well, I scan every night or morning a whole bunch of stocks, and I come up with a favorites list. I send down, watch, this is MRO and J Blue and Oxy, right? So that night before, I had sent to the room members this watch list, daily watches for April 6th. This is what everybody gets in their email, and we also have it in the room the next day. And you'll see that on here, there's MRO, there's Oxy, and there's J Blue. They were on this list, and at 9 o'clock when I get on the mic, we go through and go through this list, and we reduce this all down. This is not end up what's on the screen, but we reduce this all down when we look at what's gapping in the morning, where the market's opening, and we reduce it down to a handful of stocks, maybe 4 to 8 stocks that are the hot list. And these 3 were the ones that made the hot list, along with a couple others, and they're the ones that I look for entry. So these things are brought ahead of time, shown to you, discussed. You're going to be ready to throw up listening to the discussions of the stock. So again, you don't necessarily maybe want to do it, or you decided your own judgment is not to do it, but it's on you what you want to do. What my point is that you're not in a situation where you're going to be wondering what to do or confused what to do. Hang on, I lost my marker here. There we go. So there was this week, what was last month? What if you said, okay, fine, I want to pull up and do this, and can I make a little money doing this? I got to pay to be in your room a little bit. Well, this is the summary from last month. And again, if you take this sheet for the month, this is 2 days. If you went back and added up for last month, what it ends up being is this: the room 21 risk units. I'll talk about what that is, but it means that whatever you determine to risk, you would have made 21 times that gross. There may be some expenses in your trading platform and those that have to come out of there. But it means if you had $1,000 risk, you'd make $21,000. And yes, I'm talking about from sitting there in the morning, usually a couple of hours, if you did all the trades the way that I did them. If you want to risk $500, you would have made 10,000 plus. You want to risk $200, you would have made 4,000 plus. You want to start off risking $100, well, you would have made about 2,000. You want to start off risking 50 bucks, 20 bucks, whatever it is. There were 23 trading days, and I ended up taking between 5 and 6 trades. That's high for me. My goal is to be like 2 to 3 trades, 4 tops, typically. You saw the last 2 days. I took 3 yesterday, I took 2 today, I took 1 on Monday. That's what I'd like. There are some special days last week. Sometimes when I take more trades, it's a bad thing because I'm trying to come back from a bad morning. That was the case on a couple days. There was a couple days where I was adding to a nice profitable day, and we had just some fluky days last month. I thought it was, just some weird days where things didn't set up till later. We did some stuff in the morning, came back at lunch, but for the most part, it's more than I'd like to do. Percentage of trades that you were discussed ahead of time, virtually all of them. That's just a soft number. It's not an actual statistic. I'm just saying virtually all the time. These are things that you can follow along with if you want to. Real quickly, some people sometimes ask, well, what's the return on investment? It's a silly question, day trading, because it's not an investment. It's active. You're working. You're using this money to work. But if you went through the math and you just took yesterday, 500 risk per trade, it would have required $32,000 in a 4-to-1 day trading account. I'll talk about that in a second. It would have been only $12,000 of capital needed in a 10-to-1 account. It means that your return would have been 1,600% APR, or 2.5 times it if you use a day trading account. But it's silly talk because, you can also lose a lot that way, but it's not really return on investment. It's working capital. We tend to talk about risk units when you're day trading. In other words, we always base our results on what we've risked. If you're willing to risk so much money, and some of you may be familiar with the term, reward to risk in a trade. Before a trade, you may say, well, I see a profit here of 30 cents on the chart, and I'm gonna take a stop of 20 cents at the most, so that's a 1.5 reward to risk. Well, it's the same thing after the fact. Whatever you're willing to risk, how much did you make in terms of risk units that you were willing to risk? So yesterday was a 4 risk unit day. If you're risking $500, it was a $2,000 day. If you're risking $100, it was a $400 day. You may start off risking $10, whatever it is. As a matter of fact, for the seminar students who are learning to do this for themselves, I insist that they start off on paper and then risking $5 and $10. Even if you're gonna follow me in the room, start off very, very small, because you're gonna do stupid things. I've had people follow me when I have a perfect profitable day and they lose money somehow. People do dumb things. So start off small and build your way up no matter what you're doing. I believe in caution, believe in making money, not taking risk or chances, okay? As you get better, there's no upper limit to what you can risk. You can $1,000 a trade, 1,500. The only barrier you'll come to is at some point you have to get the share size to justify that, and it means your stock selection is going to be reduced. You're going to have to trade stock like Bank of America. If you want to risk $2,000 a trade or something, you're going to have to get to the top 20 to 50 stocks in the market in order to have the volume to get the shares that you need. But I don't think that's a problem for most people right now. On the free stuff page, which I think Sherry has posted for you, there's a whole lot of videos, and there's a new section called the Hall of Fame. And in the Hall of Fame is a video called From Chart Reader to Trader Investor. It talks about this whole R unit concept and the 2 biggest mistakes people make when they come to trading or investing, how they start off and how they end up. So view that video. It's the one I would recommend. View the whole Hall of Fame. As a matter of fact, view everything on the free stuff page. I have people, sometimes I get an email late Sunday saying, I found your free stuff page. I spent the entire weekend looking at stuff. So go through that. The free stuff page you can go to right now. You don't need to be a member. You don't need anything. I suggest you do sign up to be a member and you get other educational events. Boom, where are we? The trade. Let me go over one trade with you and show you what's involved. I have about 8 minutes here and we're getting toward the end. The trade that you saw on yesterday, the first one was MRO. How does that get to be on my screen? Why does that become a day trade? To understand everything behind what I'm about to say, you'd have to have the knowledge that I have as a seminar student. I can't hide that, but let me go through and say the words, and it'll click with a lot of you. And I don't know if you'll be able to reproduce this from what I'm saying, but at least you can understand. This is what I saw. This was the chart the day before the trade, and this is what it looked like. This is what I saw, and when I scan hourly charts, and I like this chart. I liked it a lot. I liked it enough that I put it on my list as a potential favorite for the next day. What did I like about it? Well, I'll show you what I liked about it. I like the fact that this pullback the prior day came back to a key support level. There's both minor support and major support. Understanding support is a big deal in the market. I've seen people define support. Most definitions you learn when you go to websites and to fairly uneducated people who try to teach you stuff is you're going to learn just enough to lose money. I'm not saying what they're saying is wrong. It's just woefully incomplete. So there are key areas of support you have to understand. That's a great area of support, and it's the reason I focused on this as 4 out of 300 stocks. So 300 patterns I looked at and 4 stocks I selected to look at the next day. Number 2, it came out of that area the day before on a wide range igniting bar. They're not all good. Sometimes they are. The trade was taken right in here as it came over this area. So let me come down to time frame now and show you the 1-minute chart that morning. Now, I'm not a scalper, but if you're going to take trades the opening half hour, the 1-minute chart is what you're using. The 1-minute chart this morning, there's a very key thing that it ended the day like this. It's what I call a little mini mattress, and it makes a great launching pad. And then the next day, it had this wide range bar again. Now, some of you may be saying, yeah, wide range bar, that's very bullish. Was that part of this trade, do you think? Was that a key concept in me getting into this? I wish I could see you type right now, but think about it. Was that a key thing in me getting in? If you answered yes, you're way incorrect, because we have to be better than that. I can't make money waiting to get in here and have a stop down here, because then even this huge move makes nothing. I was in here. Let me erase all that. I was in here, remember, 11:30. I was in there. How do you do that? Well, you have to understand, have the confidence to know whether this is going to go higher or lower out of the gates. So that wide range bar was not where I got into the trade up here. This wide range bar is where I took my first target just shortly after entry. I don't normally like to do that, but when you make, theoretically, that was my whole day's goal if I sold the whole thing right there. So that's an exit, and then you can see the rest of the trade, how it goes from there. So that is the strategic concept that goes into a day trade. And by the way, analyzing that chart on a day trade, it's absolutely no different long term. It's just we're using different charts. Instead of using a 60-minute and coming down to a 15 or a 5 or a 1, we're using a weekly chart and coming down to a daily or a 60. So it's all the same concepts. Nothing changes except the charts that you're using. The strategies are all the same. That's key. That was nice. Boom. There we go. I've debated putting this slide up, but I thought it would be kind of funny and also kind of get you in tune with what I'm trying to say, is that you don't need to be a market professional to do this, not even to learn it. So I put a little comparison here. The average person, the average family, hey, like to make some extra money, save for vacation, whatever it is. Okay, well, one of us has to go out to Walmart and cashier there. Okay, well, here's another idea. Why don't you day trade 3 days a week? 3 days a week from 9 to 11. Risk $100. Not initially, not day one, but maybe after a couple weeks, risk $100. That would be, if you made an hour a day, a risk unit a day, that would be $300 a week. You'd be putting in 6 hours a week for your work week. You'd have to get up in time to be at the screen by 9 o'clock. So maybe you have to get up 5 minutes early to make your coffee. There's no transportation, no gas, no wear and tear. Your lunch is only a few steps away. You have to pay a trading fee, which is right now is $179. It may go up in the future, but right now it's $179. And you may have some account expenses, but you make $1,303 income less $179, $1,124. You can give yourself a raise whenever you want. Whenever you feel confident, you can increase this risk amount above $100. If you want to do that at Walmart, well, you'd have to work 86 hours that month to make $1,303. You have to get up early, get time to drive there, get yourself ready for work. You'd also have the expenses of gas, auto, wear and tear, blah, blah, blah. This is a little tongue in cheek, but it's not really. It's a real thing I'm trying to say to you. You don't need to be, a matter of fact, the least person I ever want to have contact me is a stockbroker, a former market professional. They're stubborn and they don't know what they're doing. Who do I love? My favorite students have always been people just, well, I owned some stocks a while ago, but I really don't know anything about the market. That's my favorite type person. I had a, matter of fact, there'll be an email about it because I got a real nice comment from her. I had a, well, I know she's a grandma and she took my classes, was in the room for 6 months. She sent me an email saying, Paul, I don't want to be in the room anymore. And she also had the long-term letter. I don't need the letter. She said, I've learned what you've taught me. I'm doing it on my own. I love your letter and room, but I just want to do this on my own. I'm doing great. Thank you so much. That's what some people do. And that was a person who knew nothing about the market at all. Why can't you do this? Experience and skill. Well, you can start off just following in the room. You don't have to learn it. You can learn later if you want to. Capital. There is a day trader rule that says in order to day trade, you have to have $25,000 in the account. It gives you 4-to-1 leverage, so you could be trading $100,000. However, there is a way to do that with much less money if you want to. It's called prop trading, and you can start with $3,000 and have 10-to-1 leverage. This is a firm that I am not a part of. It says not through DTS. It is a firm that I've known the principals of for a long time. I'm not part of this, not an employee. I'm not on their payroll, nothing to do with them. My goal here is to say to some people, if you want to day trade, I don't want you to do this if if you're broke and you're trying to make money. But for those of you that want to make extra income and you're doing okay and your money is somewhere else, you can day trade with $3,000 and you can be doing it in a couple of days. It's your decision if you want to do it. If you want to put that $3,000 in and lose it all in a week, you can do that. You have the right to do that. And if you are interested in that, you need to email me and I will send you the details and put you in touch with the company that does that. And Sherry, if you would put my email out there, that would be great. And also you can use my email if you have any questions. And what perfect timing, it's 4 o'clock and I'm done. And Sherry, are there any questions for me or do we have to call it at 4? They can always email me. Sherry, it's 4 o'clock.
Oh, you want to stop on time, do you?
I don't want to, but I am kind of a stickler for people wanting to go about their lives and stuff, but I am done. Here's my final slide. And if there are any questions, I will take them. And also I asked if you could post my email so people could find out about the prop trading. So if they have questions for me.
And now is the time to ask your questions, folks. And I'm going to post up Paul's email address again. I've put up several links that he asked me to put up at different times.
Thank you.
One person here, I don't know if you saw it, but Mark said the jokes are usually pretty good in the room, I guess.
Yeah, well, he probably are buttering me up for something. They're not really that good, but thanks anyhow, Mark.
And then Scott said, just covered the rest of my HBAN for another R.
Ah, nice. I know what he means. So it's trade from the room we were talking about that he beat me on the entry. I know Scott.
All right.
He's a joker too, but yeah, he beat me on that.
All right. If anyone has any questions, you need to type them in now because I can tell Paul's got another appointment he's got to be at.
No,
Charles wants
I have
to
an
know.
appointment with dinner. I didn't have lunch today, sure, so I'm a little hungry. But other than that, I'm usually bored most of the time, to tell you the truth.
Well,
I will tell you though, half the people are asleep because I bored them to death, and half the people are so dazed and amazed they don't know what to say.
We still have quite a few people on here, so I know they were listening up pretty good. Are you allowed to trade? Charles wants to know, are you allowed to trade options, or is that breaking DTS rules?
DTS rules. Well, that's an interesting question. DTS has no rules because I am me and I'm showing you what to do, and you can do whatever you want. Now, day trading with options, I don't generally recommend because it's tough to do. It's not the best thing. It's harder to get filled, etc. Options are strategies you can do longer term. That's fine. But I recommend that if you're limited on funds, that you look at the prop trading concept and take shares. You lose some of it trying to get the options most of the time. I'm very well versed in options. I don't use them for day trading.
Okay, cool. And then Eric wants to know, how often do you cover indexes or futures?
Every day as part of my analysis in the room, we talk about, I'm very big on analyzing the market because I use it for a backdrop, Eric. I always have a market bias, and I try and trade stocks around a market bias. So when I have a bullish bias, I try and look for the best long positions, etc. So I'm always analyzing the market. I sometimes will actually take a trade on the futures when it's the best thing to do. That's only about once every 2 weeks because I explained, I think I get one of my best edges from taking stocks that are weaker than the market when the market's weak and vice versa.
Awesome. All right. Anybody else? You got 5, 4, 3. Oh, wait a second. Here we go. Here we go. Charles wants to know, is the $179 trading room fees monthly?
Monthly, yes, not per day. I know
And
it's worth it that per day, but he probably thought yearly. No, it is monthly. And if you do annual, there's a little bit of a discount, not a big deal. And also if you would be interested in the letter, there's a little combination discount, but basically it's 179 monthly, yes.
all right, so I'm also going to relink the free stuff because
Thank you.
Srinivas, and please forgive me if I said your name wrong, says that they're not working. So
The
try
links?
to click that one. Yeah, well, and I just popped it. It's working on my computer, so
Okay.
let us know if it's
We'll
not.
just
You may
copy
have
and
to
paste
type
it,
it
guys.
right in. Yeah, copy. Well, in the chat, you can just click it and it should open
Yeah.
up a new tab in your browser. So now I think you said calendar was not working, and I'm gonna
Well, Sherry, for all of
post
them,
that one again.
once anyone works, on the left side, you'll see the index and you can go to the calendar.
Excellent.
And also for the person had a question on pricing, if you go to where it says trading room / letters, right on top, there's a price sheet, just, so everything's right there in front of you, right on top. And you
Oh
can read
yeah, it's
about
all
each
there
of
on
the
the left.
services. Yeah, so if you're there, you can't miss it. And when you're there, you'll see also there's another spot you can become a member. You can sign up to become a member there, which again is no hassle, no credit card, make up your name, don't use a name. You'll just get on a list to get information. That's all it is.
Okay, he says it did work, so we should be good on that. Now, free trial link. That is sign up member only or sign up member only event intro.
Well, those two members they're for memberships, but there should be one that says trial at the end of it for people who want to try out the room. There's a trial they can take for a week.
When I talk to you, it's like you sound like a guy.
It says free stuff calendar, sign up member only, sign up member only
on the
event
left,
intro.
yeah. Well,
LTT.
if you're on the site, you'd have to go to trading room.
Well, go
and then
ahead and
down
share
there's a
that.
spot to get,
I think
but
you had it
I
up
will
for a second
give you
there.
the direct link.
Yeah, I was gonna say show them what it looks like. You had it up for a second.
Yeah, right here.
Oh yeah, well I mean that's a mock-up of it. Oh, that's not what I'm seeing. Oh,
it looks a little different. The website has changed slightly. Yeah, it's the same thing. It's just the DTS logo was changed, moved down. It's a little different, but it's the same thing.
It's in a circle now.
Yeah. But it's the same site. You can see the main part of the site, and the middle part changes because we advertise different things. But
okay, I'm going to free stuff. Welcome to the free page. Just scroll down that free page, you guys. It's crazy. There's a lot of videos there. And then a pop-up comes there and gives you enter your email for a free membership.
Right.
Yeah. Okay, cool.
And Sherry,
right,
here's the trial. If you didn't have that, I'll put it in the room and you can forward it.
Okay.
There's the trial. For the people who want to go there, you can come join us for a week. You do have to put in a credit card, of course, but if you don't want pay the $9, you can have it refunded. Just say, give me my $9 back. We're not trying to collect $9. We just need to know who's in the room. So you can take a trial for a week for free.
And I'll take that to the entire audience.
Thank you.
There you go. There's the trading room trial. That was not on the email, by the way.
Oops, my bad. Sorry.
Oh, excuse me. It is. It was. I did. I put it up when you were on obstacles. Yeah. Sorry, guys. Hey, I like to make things a little difficult. Yeah. All right. So, everybody, thank you so much, Paul. This has been great. I appreciate you joining us. And I just want to tell everybody, I appreciate you being here. I want to thank my presenters for joining us today and thank everybody for attending. This is your host, Sherry, saying trade well.